NCI. Jump. Jump. Watch the spread. ORKT. Shout. PSLV. NCI. FRMI. NBCR. 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 NBCR.
PFLT.
NCI. NBCR. EVLT. Jump. Jump.
CDTG. CDTG.
NCI. Jump. MNTS. Jump. FSLY.
PER.
Jump. Jump.
ONFO.
NVCR.
CENV.
FSLY. Jump. GNLN. Jump.
Shout. 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 Shout.
Jump.
Shout.
GNLN. GNLN. Jump. PSLV. BHP. Watch the spread. NVCR. Sony. CCCS. NVCR. Jump. PSLV. HPLN. Suna.
NOS.
MBAI. MBAI. KD. Jump.
VRN.
View. Big spread. NVCR. 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 Ciao. Oh. NVCR.
PRTX.
Solar. NVCR. Big spread. Sony. Ciao. GNLN. Ciao.
Ciao. Ciao.
Ciao. ORKT. GNLN. ORKT. NVDN. NVCR. Ciao. NCI. Sony. Asti. Ciao. GNLN. 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 PBR. NCI. ORKT.
BRTX, REVN.
Ciao. ORKT. 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 Ciao. Watch the spread. NVCR. NVCR. ORKT. MB.
CTW. 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 Qvcgp AMTASP
Watch the spread. ADVR. Watch the spread. NVCR. NVCR. HNGE. Watch the spread. DRP. Watch the spread. GNLM. ORKT. Ciao.
LHSW LHSW CLNN
ORKT. GNLN. ORKT. GNLN. ALLR. ORKT. GNLN. ORKT. ORKT. GNLN. ORKT. Ciao. SMFG. NVCR.
LHSW
NVCR. NVCR. Ciao. SMX. Big Spread. PSLV. PRFX.
YAAS. ELAB. ELAB.
Shell. Dem. NVCR. PRFX.
DAIC.
ORKT.
ELAB.
ORKT. FSLY.
BNZI. BNZI.
Mute. Big Spread. NVCR. ORKT. NVCR. HTLM.
BNZI.
NVCR. DNN. BNZI. Stim. Mute.
RRGB.
SNDK. Watch the spread. AAPL. CGNX. Clark.
LHSW. LHSW.
Zilla.
LHSW. LHSW. LHSW.
HWM. Watch the spread.
LHSW. LHSW.
INTC. SNDK. Big spread. NVCR. NVDA. GNLM. EQX. ESLV. APIS.
Kappa. IBG.
GNLM. ORKT. APIS. HTLM. MNDS. BATL. PSLV. JLHL. Watch the spread. Shell.
MRM. MRM.
ADVX. Big spread. ADVX. Big spread. DLHL. Big spread. OCUL. HURN.
Hein.
GNLN. PSLV. Big spread. CCCS. HLP. NVCR. MUFG. GNLN.
Tax.
PRFX. ORKT. NCI.
Back with another weekly preview. It's AK-47, PrimeTradingInvestments.com. It's September the 15th through the 19th. SPY at all time.
WDC. Watch the spread. INTC.
All right, here we are back
OCUL.
with another weekly preview. AK-47.
Watch the
Also,
spread.
let's tease up another AKNR. Of course, you see the prime, amazing AK-47 that we have. There's Voltron and some of the students from the one that we just had a couple of weeks ago in DFW, big 6,000 square foot house, had a pool, hot tub, all the goods, taking everyone out to eat. Some of the learning that you get in education right there. Monday, Tuesday, you get 5 hours each one of those days. 2 or 3 we had on Wednesday. Had CR Trader there. So again, a great event. If you're looking to come trade live with me, we've got another one coming up. I'll tease that more coming up this week. Tickets go on sale on Friday. That'll be in New Orleans. Here are some of the teas from the last one. Of course, the video that I have on YouTube, just to show some of the stuff that we did last time. But if you're looking to up your trading game, I can't tell you how much this has helped the traders that were there. Had 7 different traders join me from across the globe. And in their first week back, some of these traders, I can go through each one of them. There's CR Trader, AK-48, essentially, as we call them. But these traders, since they've been back, Tay, he's up big this week, a few thousand. I know Lone Wolf's up. Fred's up a few thousand this week. He's had a few $1,000 bangers. He's up like 10. These guys alone are up $10,000+ this week. Their very first full week back, which was this last Monday through Friday, they're up over $10,000+, like collectively through the whole entire group. So you can see here, we cooked together, we trained together, we had fun together, got out in the BMW and had some fun with some of the traders in Voltron, my BMW X5M competition. So if you're looking to up your game, I can't tell you how much this has helped those traders, because that's what it's about. It's about going to school and teaching them big time, big time. Of course, then at the end of the day, we're cooking together and having fun together and bringing that camaraderie and teamship, so they're still messaging each other each and every day in the group text and message chat that we have. So again, New Orleans tickets go on sale this Friday. We'll be in New Orleans February the 24th through the 28th. If you're looking to up your game, get with other traders that know a lot about trading. And then in the end, you build, again, these little friendships, traderships, as I call them. So you're going to be talking to someone nonstop. You have someone to talk to. Because a lot of people on this journey, as you know, they don't have a lot of people to talk to. They feel like they're essentially an independent person out on this mission trying to go to Mars and trying to fly this, build this rocket ship. They're trying to create their own NASA, right, or SpaceX, whatever. And it's hard to do that without any help. You can't bitch or complain to moan anyone. And that's, of course, why I do my one-on-ones, which I'll get to in just a minute. But this is the biggest thing. If you want the most help, I can't tell you, again, like literally the first week out of this, all of the traders are green and banked. And I taught them here how to become their own individual traders, going through and helping them out, going through their own little trading stations. As you can see, they had nice little trading station setups, huh? Take them out to Top Golf, all the different cool, fun things that we did after the fact. All of it's paid for. $17.47 per person. That's not a lot if you think about it. CR Trader had fresh lobster flown up. So again, a great time if you're looking to learn. This is by far, I can't tell you how much this will up your trading career and journey. $17.47 per person, and these guys have made. I think each person has already made that back this week. Literally, if not, some of them made way more than that this week, and that's only their first week out of the AKNR. So again, if you're looking to have some fun, you can see we're having it at the AKNR. Where can you come find me and doing one-on-ones? Right here, primetradinginvestments.com. Prime Trading, Optimus Prime, baby. Doing one-on-ones, streaming live with traders, doing morning voice alerts, which is very awesome. So if you're looking to up your game on a day-in, day-out basis, yearly stream, the morning live stream, the morning alerts, whatever it is. If you need help in the morning alerts, again, here's just banger alerts. And there was one day, it was last Friday, I went through and listened. It was just 3 different random ones, and my high of day or low of day were hit like within 15, 20, 30 cents in large cap plays. And so here's essentially kind of a great thing, what to trade at the bell. Plays at the bell are going to be those large cap plays I talked about, which would be Circle under 134 for the short, Google over 205.50 for the long, which it looks like it could be happening here in pre-market and ruining that for-market in-market trade, and PLTR shorting that under yesterday's low of day would be great. So Circle under 134, Google over 205.50 for the long, and PLTR shorting that under yesterday's low of day of 179.20. Besides then going through and giving you levels and where to trade those individual tickers, where I think high of day and low of day will be giving you levels in between there, so you can trade these levels, going long, going short. Small caps, where to go long, where to go short. PPSI was a short that we traded that morning, and I'm telling everyone where to get in and when I am short, what my stop loss is, leading them through the trade to hold on to that trade. And back to that PLTR, remember that PLTR alert I just gave? Point of no return is the lower shadows. So PLTR, if we're trading this, I'm waiting to see a lower shadow get created here, or was 3-minute candlestick confirmation below for the move down. So it's either one of the two. So the lower shadow is at 875 rule. Makes a lot of sense. So if we get below that point of no return, we just jump in. Or candlestick confirmation now below it. That's our new low area that we'd wait to get in. If we see below that, that's where you start jumping in for the short opportunity on the way down for PLTR. So waiting on that, getting the pullback from this. Oh shit, it's going. I'm just going to jump in here. 10 contracts team, small contract size for that move down again. See, we get down to 170. Let's go! 177.50 is getting hit. 177.50 is getting hit. Let me sell a little bit. Here. I'm selling 5. All right, there we go. All right, let me sell. Go ahead, just lock up a little bit more. Locked up 7 there. Anyone in on PLTR right now with me? If you want to lock it all up, you can. I want to get down to 176.50. If we can get down to 176.50, we're money. All right, 176. Here we go. I'm just going to go flatten out right now. $1,000 fucking trade. 850. 850. Let's fucking go. There we go. Oh. Go ahead and mute that, and we'll just watch how it goes down to. I wanted 176.50, so you can see where the candles are confirmation right there, bouncing back up off of it. So pretty much my target got hit right out of the gate. I wanted underneath low of day for that crack back on down. And if we kept watching PLTR here, let's keep watching it. Look at that bounce. Bounce up, and then once it cracks, it even went down for even more. So there's that short right out of the bell alerted for you guys. What to trade at the bell, there's your short right there. And if you would have got in right where we did, which was in the 178s where we got in, we never saw our entry price again. It just kept collapsing. Beautiful, beautiful trade out of the bell. Then using our levels right here. Of course, it's a small cap play in the breakout. Running into resistance we found in past chart history, failing at it. If you want day in, day out help, this is where it's at. You got my Discord rocking and rolling. Of course, as I talked about, I'll do a free live stream coming up this Friday to get ready for the New Orleans Track Edition tickets. So again, I got it all going for you. If you want a live stream where I'm going through small cap plays, going through large cap plays, so you know what to trade all day long, I've got you covered, right? Got you covered. Small cap to large cap. Got the lines in. We can trade our lines. Put your lines in and trade them. Small cap to large cap. If you need help in the morning with morning alerts, what to trade at the bell, what large cap plays to trade for the day, let's just again right here go through this. And I'll make this bigger so you know I'm not just making things up. You're like, hey, he talks fast. Maybe you could just ring these through. Look what I'm giving you in the morning alerts. This is Friday. Friday right there. Let's go you Friday. So you can see there's Friday, right? Hold on a sec here if I can find it. There we go. There's Friday. There's Friday where we start. Small caps, PPSI, PGen, right? So PPS small caps, PPSI. Here we go. I'm going to read through these real quickly so you can see. Well, I wish you could. You can just see here. Look how many you're getting. I'll just do this. SPY, give you a picture. More breakdown. Look how many. Look at this. I'm not even just. Look, I'm just getting into large caps. Look at this. Look at that. Look how many you're getting. I haven't even scrolled through them all yet. Look, I haven't scrolled through them. There we go. So on Friday, you've got small caps dead. PPSI, PGen, PPSI, BSLK. Shorting under support. Letting them know what's going on. About shorting under support and how that's slowly working again. SPY, Apple, AMD, PPSI, Circle, Google, Meta, NVDA, PLTR, QQQ, SMCI, Tesla, what to trade at the bell, TIVC bounce, TIVC, PPSI. All the way through. All the way through. I mean, that's on a Friday. So if you need help, not only in the that's all before the opening bell. Like those all come in, the morning alerts come in. Those started at 8:01 Eastern. 8:01 Eastern. An hour and a half before the opening bell, and continued all the way into an hour into the opening bell. So essentially, you got alerts from what's my time? 7:01, but 8:01 Eastern. 8:01, 8:02, 8:05, 8:10, 8:11, up to 8:15, 8:23, 8:24, 8:28, 8:29, 8:33, 8:39, 8:42, 44 after, 45 after. I'm reading 48 after, 49 after, 52, 53 after, 55 after, and then moving into the opening bell, going over more plays, or right before the opening bell. That's all in the morning alerts. That's 30 a month. I have so many people. I want to ring off different names that have said, you could charge me $100 a month. I would pay way more than 30 a month. 30 a month's a steal. It is. That down the line, when I stop going live, I'll probably up that to 50 or 70 a month. What you're getting on that, again, I've got traders like back to CR Trader that you just saw right here at my seminar. And let's just go up right here to my man that was actually giving a live presentation at the AKNR, and everyone couldn't wait to get it. And everyone calls them, you know, essentially AK-48 now. I did one-on-ones with him last April. He's had morning alert since last April. The guy's made close to about $500,000, $400,000, somewhere in that range. There's a guy named Rick C in chat that follows me and gets my morning alerts, the morning alerts, and paid $30 a month. So just morning alerts alone, $30 a month. He's paid about $400 to $500 probably since he's first had the morning alert, somewhere in there at most. At most, both of them have. Both of them have probably invested $800 to $1,000 combined, and have made close to $750,000, $800,000 combined off the morning alerts. Then you add in the one-on-ones that I do, which I just kind of kept my summer sale going on. So if you win a summer sale, that's what these guys have banked. They have come over and do these one-on-ones with me for $200. That's $50 an hour. Name another person that does small cap, large cap, goes through all the levels, can do lot options as well, that charges $50 an hour. You know, and this is like $35 to $40 an hour. Absolute steal of a deal. If you need help, I do it all. There's not another live streamer out there that does live stream, breaks down plays every day and trades right there in front of you, what to trade at the bell throughout the day, and helps you out through in your trade. So when you're in trades, I'll lean you through them. You can have so many traders. So I can go through like right here on the Discord, right here, go back to my man Bart, man. Here we go. Yeah, the GOAT AK again with BSOK jumped in 1K in 3 minutes. Now I just have to learn and see it like AK, where I'm alerting these plays well ahead of time where traders want to trade at and what to do ahead of time. Then I've got all these badass other traders over here that are putting their charts out and where to trade. You know, other cousins, CR Trader, Love Chip, you name it. Tons of other traders out there. You need help day in, day out. We got you covered. I'm sorry, I was covering the map up just a little bit right there. But anywho, right here where I was calling out Bart, man, he was saying I have to learn like AK. So boom, right there. Boom, jumped in, made 1K in 3 minutes on BSOK on Friday. Boom. You need help. There's not another live stream that's helping you in other plays that I'm taking or may not be taking. Hey, I'm about to go do this, or hey, I've got this going on, or hey, I'm not trading that setup, but I like this. Here's what because I'm not comfortable about it because I alert everything. $70 a month for a live stream to help you out, make you bank with me, bank on your own, become your own badass trader. $30 a month for the morning alerts. I'm doing morning alerts, breaking things down in pre-market so you know where to trade small caps and large caps. For the year, it's $1,000 for both. That's ridiculous. They're your level or your numbers though. And then of course I'm doing one-on-one. So within a day, I wake up in the morning and I'm usually starting off right there, get my live stream up. My live stream comes up at 8 a.m. That's when of course you just heard the morning alert start. So I'm starting these two at the same time. Then generally about 2 days out of the week, I'm getting into a one-on-one at that time in pre-market. So I've got 3 things going on at once. Get the live stream up, throw some morning alerts out, and hurry up and join my one-on-one. So just like on Friday, and I'll show you real quickly, we can trade plays like PPSI, which again was that first alert I said, hey, PPSI, there's a great shelf crack under 6 or I forgot what it was. Let's go to PPSI on Friday here. PPSI. Right here. Where was the shelf crack? Oh, it's when I come in. So right here. Right here. There it is. 470 shelf crack. There was another one earlier this week that was 6. So I said, hey, there's building up this kind of staircasing down. There's a stair, there's a stair, there's a stair, right? One wave, second wave, third wave. This one's the first one below the VWAP. Generally, if you crack it, you're going to get an okay pullback. You'll get another pullback. This one was a decent short for us on Friday for we'll trade the pool on Friday. We got that with trade the pool. Not a big profit, like $400 or $500 I think for most traders, somewhere in there. Not a lot, but something. Got about 30 cents or so. So I immediately get my live stream up right here, right there. Got the morning alerts up into a one-on-one. Hey, I have a boom. So it's live stream up. Hey guys, here's what we're doing because I've got the live stream up, but then I'm alerting up my phone at the same time. All right, guys. Hey guys on live stream as well. Don't forget we got PPSI. We got a shelf here at 473. Watch for a shelf crack down to around that 455 area and under 455. Watch for it to consolidate somewhere around 445 down to somewhere around 445. I doubt it gets lower than that. And then this lower VWAP band right around the 430, 440 mark, that's why. It's consolidating. It's going to bounce somewhere in there back up. So there, I'm telling not only traders in my live stream, in the morning alerts, but then I'm in a one-on-one. So everyone's getting to know what's going on. And I've got all that going on at once. And then also what I'm telling you there's a short to be had, but then also there's a bounce to be had. Somewhere in this blue line demand zone area. Which you can see comes bouncing later on, then becomes resistance, becomes from demand to supply. Teaching you this day in, day out. All right, let's give you levels real quickly. Now you get the gist of it. Monday through Friday, I'm doing morning alerts, one-on-ones, live stream all at the same time. Morning alerts and the one-on-ones and the live stream throughout pre-market. Then I'm done with that one-on-one and I'm concentrating solely on my live stream and you guys on the live stream. 15, 20 minutes in opening, right before that open, like you just saw me. All right, guys, here's what we're looking for. Like I just showed you. Right here on display, right here. Like, hey, what are we looking for? What are we looking for, right? You can see I'm right here on the horn before the opening bell or wherever the opening bell was. Getting to you guys so that way you know what to trade. So right here, as you can see, I'm in here in pre-market 15, 20 minutes beforehand. What are we looking for? I'm letting everybody know from small cap to large cap what to be trading and what I'm going to be trading. And if I miss it, what you need to be trading. And then I do that for about an hour and a half into the opening bell. Cut it off, get into one-on-ones. Or I'm going live on Trade the Pool. Take a break. Got one-on-ones in the afternoon. All right, let's get into levels for the week. SPY, beautiful uptrend channel, finally breaking on Friday. I knew this wasn't going to last forever. It was a 2-week uptrend channel. Finally cracked a little bit on Friday. Now consolidating out to the right, which I would imagine we get this week. Lows basing around the 638 area. Normal lows there. Ultimate lows going back down and having a big pull back to 630. I don't think we're going to base at 642 and go up for more. I just don't think that's going to happen. It could, though, and that's why I'm letting you know. Why? Old 52-week high was all kind of somewhere into this area for a minute. I think we're coming back down to the 630s, though. Somewhere right around right there. I could see it trying to base around the 640s. Not 642, but 640s, I guess I should say. Maybe 642. I think it's going to crack down and come back down. Normal lows somewhere right around 638.75 or something like that. Ultimate lows, bigger pullback. And I'm going to say we finally have kind of like this multi-uptrend channel crack back on down, where last Monday we were in the last Monday was 635. 34. Yeah, I don't think we can pull back all the way down to 630s. Actually, I'm going to go back on that. Normal low of the week, below this, I feel it below 641 to 638.75, somewhere in there. Normal low. Ultimate low, I'm going to go right here. Right there. So boom, right here, back to into here. We'll call it 634.50, ultimate low of the week. Somewhere right around there. Monday's low and just kind of trend back on down, if anything. Way up. 647's right here, and that high from, sorry, let me get 404. That high from pre-market. I know it's pre-market all-time high. I know it's not going to be seen by brokers and real true 52-week high all-time high. I want to see that get stuffed, that traders will look at it at least for the first few days. And if we do pop up, we get stuffed there. Normal high of the week here. Ultimate high of the week. Because, again, if we crack through this area right through here, right through there, we're going down, right? We're going to go down to the 638, 639, whatever. And so then getting back to that will be normal. Ultimate would be a move to 650. I'm going to get to say that big number of 650 holds up as ultimate high of the week. All right, let's go through some of these other plays we haven't looked at in a while. Apple finally out of its uptrend that I wasn't looking at for a while. It's so ugly. Uptrend channel slowly cracked. You can see there's uptrend right there. Finally cracked from moving basing out. Looks like it's trying to move a little bit more with how the SPY might move and basing back down. Same thing. I don't think we get this tight up top. We've been moving a little bit more recently too as well. So I think we crack under 230. Keep it on watch like SPY 641, 642 mark. I just think we crack that and come down to 625, 626. That'll be my normal low of the week somewhere in here. Ultimate low of the week does go back to that Friday spike and crazy move up. And I'll go a little lower as far as a bigger move for the week than Apple for it seemed like what would be for SPY down to 220. 220.50 ultimate low, 225.6 area normal. On the way up, same thing. I feel like this could be the base of a new trend where 635 area, nice flat round number is the ultimate or normal high of the week. Ultimate, watch for a move to 240. 240 ultimate high of the week. AMD, I think it's going to get, and it has been since it's run up to this move up. We'll just go to the 4 hour 52 or 4 hour 180, I should say. You can see it's starting to get choppy up top here. That 186.85 area, that double top's nice. I think we're going to stay with that. So we'll just kind of go back. We'll zoom in a little bit tighter here so you can see that double top. I say that's going to be your normal high of the week, ultimate high of the week. We finally move out of it and watch for a move up to 190. And why only 190 and not higher? Because if we pop out of that, we really could fly because we haven't been over that in a while. Mainly, I feel like we do have a red day somewhere between Monday and Wednesday, maybe even a couple. And so that pulls it back down. So your normal low of the week is going to be, and I feel we base out in a channel up top. Normal low 165, 166 here. ultimate low back down in this little weird juncture from Wednesday before last. If we do some, for whatever reason, have a big move this week, down to 160 area, maybe a tad below. I think Amazon's kind of gross out to the right. Oh no, we did kind of base back out here in this kind of little W shape. So normal low of the week back down to where we came from. We'll call it 224 to 226. Ultimate low back down to the bottom at 220. On the way up, watch for this move to continue, in my opinion, on this bull flag setup from Friday or Thursday into Friday. So I think we do go over 234 to 236 minimum. I think that's a misprint, but we'll stick with it because we do see some movement right here at 236.50. Normal high there. Ultimate high, a move up to this 242 mark, and that was after earnings. Traders will see that, I think, still possibly, knowing that earnings was just a couple of weeks ago, so we'll stick with that as ultimate high. Circle has been a good one. This was, of course, a great short long opportunity the last couple of days. The great crackdown. I alerted this again. This is a morning alert that I gave on Thursday for traders to short. I missed it, unfortunately, but I did get PLTR Friday. Of course, great move back up on Friday. So now do we just base back into this channel, which was around 150 to around 170-ish area? I think that does possibly happen. So we'll stick with that theme moving. We pop back up. Normal high 160, ultimate high I'll move up to 165. On the way back on down, we're going to stick with what we worked with last week. Ultimate low of the week 134, normal low of the week we'll stick with in between 134 and 150, around 142.50, somewhere right around there, and that bounce from Thursday. Go over to Google here. How is this one looking? It's not bad. Nice uptrend channel here. Beautiful uptrend, kind of like SPY. Started getting a little cracky on Friday there. On the way up, 207.30 would be your normal high of the week. I'm going to stick with an uptrend channel that sticks out to the right and flattens. Ultimate high of the week goes to 210. On the way down, 202-ish area to 201.50, normal low of the week. Ultimate low of the week, we'll stick with the round number. Actually, we'll go lower than 200. We'll go with last week's low, that ultimate nasty lower shadow. I don't know if it's a misprint or not. Regardless, it does come back from the flat top breakout that we had right through there and all that resistance. Right around 198, and that 98.75 roll, 875 roll will be your ultimate low of the week. Let's go to Meta here. This one was beautiful, finally popping up, and this does have that squeeze and 800 written all over it. Of course, all-time high area. I'm going to stick with the theme as what we've created last week as normal high of the week, 96.25. Ultimate high of the week, it goes to 800, does not stop at that round number in my opinion. Minimum gets to 805. I think it can get to 808.75 to 810. On the way down, I'm going to stick with last week's low as we did as your normal low of the week, 772.30. Ultimate low of the week comes back down, sticking with the trend we were in back down here, where 760 seemed to be a real good demand zone. Ultimate low there. Microsoft was one that needs to get out of levels right here. Keep this on watch this week back under 518. Keep it under, I'm telling you, under 518. I know it seems like we'll run back into charting, but the day we do crack 518, I don't see how we don't have a good pull. And I'm talking like we saw PLTR on Friday, had that crack down at least $6-7. I think this could be a day under this one 518 mark. Watch for a good pull, minimum to 515. Nice little round number, but I think we get down to the low 5 teens. So keep that on watch. To the long side, I just don't like it. NVDA, let's go over to this dude. Ugly, 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 ugly. Leave it alone. Do not day trade that unless it gets the new all-time high at 185.50 plus. Leave that play alone. PLTR, speaking of which, gorgeous play. On Friday, this crack we got, this nice M shape up top as well. It's another reason why I traded. I was letting traders know that double top, nice M right here was the base of, and if you draw an M, the McDonald's, the arch is right. We know the golden arches. Well, when you draw the middle part of that M and you get to this point, right, there's that base below. It's kind of like a head and shoulders pattern. So if you form a head and shoulders pattern, you got the shoulder, the head, then there's the shoulder. There's always a base of where those shoulders kind of like, you can find the bottom of where the shoulders start. When it cracks that on the right-hand side, you always get a good pullback that day. So the same thing here would be the same thing on M shape. When you're forming your M and you come up, and you can even say this is the base of your M, where you're starting to come up with the first M part of the arch, right? Well, when you make this part of the M and now you come up and then back down, that part that you created right in the middle is always a good short zone. So you see how we failed it on, or cracked it on Thursday, came down and failed it, reversed at it Friday and after, or Thursday after hours, Friday and pre-market. So I knew as we came down, there was going to be great continuation underneath this area because there's really just nothing to hold it up. And it seemed like we were going to be a magnet, and there's that 176.50 mark that I was talking about that we'd get to, this little sandwich area, old high, bounce area off of it. That was going to be a magnet for me, in my opinion. It really kind of held up a little below it, but that was kind of the base of where it held up, you can see, on Friday. So anywho, that's where I got the basis of that short. So back to this week, I'm going to go back to last week's ultimate high of the week, 190. I don't think we'll get back higher than that. Normal high of the week, I'm going to go back to the middle of the arch at 182.50. On the way down, this will be your normal low of the week, 173.30. Now again, watch underneath this, because if we crack it, where are we going? A magnet to that low right there. That's not a huge play, but it's a good 250. So watch for a normal low of the ultimate low of the week down to this 171 to 170 area. I think we just may continue on down. Now again, if we do crack this area, there's going to be a huge crack zone. So the 173 leads to 171. 171 leads down to 168 or 9, 875 rule. If we crack that, woo, yeah, where are we going to? Way down here. So this is the day I'm really looking forward to when we crack this on PLTR. SMCI has been one I've been waiting for this to crack under 44. Under 44, huge crack zone for SMCI. To the top side, got to get back over 46, 50, 75 area, and you really got to get back over 875 roll. Last but not least, I'll get into Tesla here. Ugly, just an ugly chart. There's a lot of chart to go through here. Top side, we're going to go with ultimate high of the week of this essentially 875, 875 area, 348.75, 349, whatever you want to call that. A lot of strong resistance up top. Normal high of the week, as long as this holds up, it kind of will be normal high running into ultimate high. This will be your normal high of the week as long as this old uptrend channel that was beautiful for a long time cracks. It's kind of like the same material. I talk about old resistance, new support. We keep flip-flopping back and forth between that. You'll find that also with old trend lines. So as soon as this, or as long as this keeps going up, it's going to keep going up until it finally runs into that area. So this will be your normal high of the week as this keeps going up until it runs into that, and then it'll be a combo. So your normal high of the week will be this as it rolls up, which could change each and every day. Your normal low of the week is going below last week's low for sure, which is going to be this at 327. Normal low of the week is going to here, 321.85, 322. Ultimate low of the week is going down a few more dollars, down to here, and 316.30. I just don't think we'll fill that gap back down to here yet. I'll go to Qs because I know some of you guys trade futures. It's going to be very similar. What is that in my keyboard? Oh, well, I'll get it in a little bit. To the SPY. On the way up, 583.30, normal high of the week. Ultimate high of the week goes to 386.50, 387.50, somewhere in there. On the way down, 372, normal low of the week. Ultimate low of the week goes down to 366. There's your levels. Information about me, AKNR. New Orleans tickets goes on sale this Friday. I'll have the free live stream this Friday.
On today's episode of What's Going On with Shipping, it's time to talk about the U.S. election and shipping. I'm your host, Sal Mercogliano. Welcome to today's episode. So this Tuesday, there's going to be an election in the United States. I don't know if you heard about it. It's been in the news a bit. I live in a swing state. I'll be clear. I've been bombarded by this for weeks, if not months. And I'm going to be very happy come Wednesday when this all stops. But I want to talk about what is the potential for a new Trump administration or a Harris administration regarding shipping. Now, I am very apolitical. I don't show my political affiliations. I try to be as apolitical and unbiased as I can. But hey, people are biased. Ask me about the New York Yankees. I'll give you all the bias you want on that. Not happy about the World Series in any way. But I try to keep myself as middle of the road as I can. As a college professor, I believe my job is educating, not indoctrinating. And I try to hold to the same standard here on this channel. So I'm going to lay out for you what I think are some very appropriate and things we should be aware of regarding shipping, whether it's a Trump second administration or a Harris first administration. If you're new to the channel, hey, take a moment, subscribe to the channel and hit the bell so be alerted about new videos as they come out. So one of the things we need to be aware of is that this is one of the kind of renaissance periods in American maritime legislature. I have never seen so much attention being given to shipping in the United States, whether it's publicly or out in the government right now. Now, I don't know if it's due to things like my channel out there or other things, but I think that because of several issues, COVID and the supply chain crisis, number one, Ever Given getting stuck in the Suez. We got the Houthi in the Red Sea. We had the low water in the Panama Canal. We had the backup off the coast of LA and Long Beach. You have the Dolly taking out the bridge in Baltimore. Shipping has been in the forefront of news for quite a bit here. But in Congress, we've seen some amazingly bipartisan legislation coming out. For example, Representative John Garamendi here, a Democrat from California, back in 2022, along with Congressman Dusty Johnson, Republican from South Dakota, pushed through the Ocean Shipping Reform Act. First major piece of legislation on shipping in 30 years, since the 1990s. And Representative Garamendi, along with a host of other congressmen and congresswomen, are charting this new bold course, as the article says here, toward an American maritime renaissance. It is an amazing change. Over in the Senate, you see the same thing. You have senators like Marco Rubio down in Florida, Republican, and then you get Democrats like Mark Kelly here in Arizona. Fun little fact, I went to school with Mark's brother, Scott Kelly. Scott went to the State University of New York Maritime College. Mark went to the U.S. Merchant Marine Academy, and Mark Kelly has really become one of the big advocates here for shipping. He's introduced a lot of legislation, some of it to counter Chinese issues like Chinese cranes and Chinese shipbuilding. But also, he, along with Congressman Waltz from Florida, this is not Tim Waltz running with Senator Harris for president. This is Congressman Waltz down in Florida. They have both kind of co-sponsored some legislation that are aiming to improve what is happening with American shipping. And over in the executive branch, you've seen work being done by the likes of Secretary of the Navy Carlos Del Toro, who is working to create what's called American Maritime Statecraft. This is the concept of soft power versus hard power. Listen, you don't always need a carrier battle group to do things. Sometimes you need soft power, you need a hospital ship, you need shipping, you need commercial aspects. I'm a big advocate for this. I love what Secretary Del Toro has done. He gave a speech a couple of years ago back up in Harvard that I thought was just amazing. I thought it was his breakout moment and been following it ever since. Been really involved in this too. And we're even seeing op-eds on this. Now, I'm focusing just on G-Captain here, but there have been op-eds in National Review, in the New York Times, you name it, across all the different publications out there, and regardless of political affiliations, talking about this issue, about issues regarding shipping. Here's an op-ed on U.S. merchant marine shortages that's demanding action right now, a really key issue that we're seeing. But the big thing here is there's a lot of attention being focused on shipping. Now, the question becomes, when you have a new administration comes in, when the Biden administration steps down in January and a new administration comes in, what are going to be the focuses of those two new administrations? If we assume that the Harris administration will be a continuation of the Biden administration, for example, on their maritime policy, and if the Trump administration kind of rekindles what they did during their first administration, we can see some of the impact. So this chart here from the National Retail Federation shows you the imports from 2004 to 2024 in numbers of TEUs, 20-foot equivalent units. These are 20-foot containers. Most of the containers you see on ships are 40-foot units. Those are 2 TEUs. But this gives you a measurement here. You'll notice on the chart that a couple of issues befell shipping. Obviously, in 2008, we saw that massive decline right here, where we go from about 17 million containers and it dropped all the way down to 13 million containers. Then it resumed and we saw a nice kind of steady progression right here. Then we plateaued here after 2018 over 2020. This is during the period of the Trump tariffs. One of the things we saw was when Trump passed a series of tariffs, that had an impact on the importation of goods. Now, what it also did was cause a lot of people to ship goods forward. In other words, to front load cargo coming over in anticipation of potential tariffs. And we can expect to see that again if we see either the Harris or Trump administration come in with an announcement toward tariffs. There will be an effort to get a lot of cargo into the United States prior to those tariffs kicking in. You notice the big uptick here, obviously due to the supply chain crisis, and then the fall off, but now we're once again back on this rise. And we seem to be on this kind of, if we draw this line trajectory out, we're basically right where we should have been, maybe a little bit lower than we were because of the ups and downs, the peaks and troughs that we experienced here due to COVID and the supply chain crisis. So let's take a look at the Port of Los Angeles. Port of Los Angeles for us is a good indicator of international trade because it receives so much of the goods that come in. About 40% of all the imports, exports come in through the ports of LA and Long Beach, and LA has good figures for it. So real quick, taking a look at numbers right here, you see these are the annual number of containers coming in and out of the port. Now, I should note that these are not import containers. These are import-export containers, both loaded and empty. So that's why you see such high numbers here. Notice back in 2021, we hit over 10 million containers coming in. But I want to take you back over here again to those key periods that we see. So 2008 right here. You see about 7.8 million containers coming in. Then the big drop off here into 2009 and then comes back in. That's obviously the global recession that's having a factor there. 2015, very similar, we saw it. And then in 2017 to 2018, we see again that kind of drop off start taking place here into 2019. That is those tariffs kicking in. So we can expect to see it. Right now, where we're sitting is last year we were roughly around 8 million TEUs coming in. And if you look at the calendar here so far for the past year, let's look at our accounts here. There we go. Over 7.5 million containers. That's as of September. This is not the October numbers yet. So this year is looking to be a record year in the port of LA. This chart gives you some facts and figures from the Port of LA, which I find very interesting because, again, it gives you an insight into what we're hauling in and out of our ports and how government action, particularly a new presidential administration, will be. We're hearing more and more about tariffs and trade restrictions coming in from the Biden administration. But let's be clear. A lot of the tariffs that were put back in 2018 were remaining in the Biden administration. We didn't see the Biden administration remove them. So we're not 100% clear that the Harris administration will either remove the tariffs that are currently in place or will not add to them. For example, we heard the Biden administration come out about Chinese EVs, electrical vehicles, going from a 50% tariff to a 100% tariff. Does that mean the Harris administration will follow suit? This snapshot gives you the top imports and exports into the Port of LA. So big imports coming in: furniture, over 560,000 TEUs, auto parts, apparel, plastics, electronics. So obviously any tariff on any of those are going to have an impact. And remember what happens with tariffs. We like to talk about that China will pay for tariffs, but in truth what happens is you raise the cost of the product coming in, and therefore that cost is going to get passed on to two people, the shippers and the consumers. They're going to pay for that. Now, if you're shipping the cargo over, it's going to cost you more to bring it over for obvious reasons with the tariff associated. And if you're making a percentage on the cargo coming over, you'll make more per piece of cargo coming over. In terms of exports, what's going out from the United States: paper, waste paper and paper going out, pets and animal feed, soybeans, recycled metal, fabrics, raw cottons. Notice the number differences here, that basically our biggest export, paper and waste paper, 196,000 TEUs, just gets over the fifth top import into the United States, meaning that what we export out of the United States more than anything else is empty containers, air. For every loaded export container we take out of the United States, there are about 3 empty containers that are going out. That is a big issue in terms of our trade deficit. So who's our biggest trading partners? Well, it's going to be no surprise when it comes to the Port of LA. They're focused in Asia. But the top one is China and Hong Kong at $112 billion, followed by Japan, Vietnam, South Korea, and Taiwan. Now, notice Vietnam is climbing in this number. We're seeing that happen. A lot of companies are shifting from China over to Vietnam. This has had a lot to do with issues with China, but also because of costs in China are going up, and so therefore we see it. When you look at the top 5 trade routes coming in, obviously Northeast Asia is number 1, Southeast Asia number 2, the Indian subcontinent, then Northern Europe and Mediterranean, but those are very fractional. It is Northeast and Southeast Asia that is taking up 88% of all the trade that comes in and out of LA. Next, I want to take you to this chart. It's provided over on the Port of LA site. This is U.S. trade numbers. They do a great job in kind of synthesizing where trade goes. This shows U.S. trade with the world. This is as of through August of 2024. And as you see here, where's our trade going? Well, one of the, obviously the biggest ones are our neighbors, both Canada and Mexico, but also over to China, Japan, and Korea. When we break this down by value so far, as of this is the year to date, we're looking at trade partners, a total of $3.5 trillion have been traded. If we jump back to 2023, the total there was $5.1 trillion. Largest trading by value was with Mexico, followed by Canada, China, Germany, and Japan. So obviously, any tariff that deals with China, for example, will have an issue. But again, we get more from Mexico and Canada. When we look in terms of tonnage, what we see is the most tonnage comes in from China with 12% coming in. Jump down here when we look at our trade snapshot by value, again for year to date, about $3.51 trillion, about a little bit over 1 billion tons of cargo coming in. And you can look at the surplus deficit here in terms of exports versus imports, 61% in terms of imports versus 39%, in terms of exports. Same thing, let's look at exports, $1.38 trillion. That is year to date. If we jump it over to 2023, we saw a total of just over $2 trillion, with the largest good going out is oil at 5.8%, civilian aircraft parts 5.6%, gasoline 5.6%, LNG at 3.3%, and vehicles 3.1%. If we change it over to tonnage, it is oil that is the biggest one, followed by natural gas, gasoline, coal, and then soybeans. So obviously energy is one of the biggest exporters that we're seeing coming out here from the United States. The energy one is very interesting to look at because there's some discussion, for example, about requiring some energy exports coming out of the United States to be on U.S. ships, what is referred to as cargo preference. We repealed the law back in 2015, for example, on export of U.S. crude oil. We opened it up that you can export U.S. crude oil. And what we've seen is U.S. crude oil production has just gone through the roof. It has increased almost fourfold in terms of exports that we've seen happen. But we don't require it to be exported on U.S. flagged vessels. But there's a lot of issues with protectionism, a lot of concerns about national security. China, if you watch my video on the review of maritime transport, China is now building over 51% of the world's ships. And there's a big concern that China is getting all facets of the maritime industry under their control. If we jump over to imports, $2.13 trillion year to date so far. Again, this is as of August. If we jump ahead here for last year, a little over $3 trillion in terms of imports. When we look at the value, it's passenger vehicles, oil, cell phones, computers, and returned exports. 23% of the imports is oil coming in. Now, you're going to sit there and say, well, wait a minute, Sal, we're exporting oil and we're importing oil. That has to do with the type of oil involved. We tend to export a lot of light, sweet crude oil that comes from fracking because our refineries aren't geared to it. Our refineries are geared to kind of heavy or sour crude oil, and that's the kind we need for putting into our refineries. So if you look in tonnage then, 583 million tons of cargo going out, with the vast majority of that oil, gasoline, aluminous and slag cement, pebbles, and various forms, I believe it's salt, of salt coming out. If we look at ports, what ports are the busiest? Port Laredo on the U.S.-Mexico border is the busiest one in terms of value. That's as of this year, 3.51. If we go annually, 5.1 trillion last year, still the Port of Laredo. But if we start looking at tonnage, all of a sudden it becomes the seaports. Port of Houston, Corpus Christi, Port of New Orleans, Port of Los Angeles, and Port of Newark trump all the overland ports because of the volume involved. Again, ships are where you move tonnage. And just a quick graph showing you the exports over imports over time. Most people tend to think we just import all the time. We do export a great deal of cargo. The problem is that surplus. We're doing about 2 imports for every 1 export. And so you got that 2/3 split there roughly that we're seeing. If we look at U.S. trade, has decreased 4.08% through November. U.S. trade with the world totaled $4.69 trillion during the first 11 months of 2023, according to World City Analysis. If you look at the U.S. leading trade partners, number 1, Mexico, number 2, Canada, number 3, China, number 4, Germany, and number 5, Japan, all of them fell except for trade with Germany, and this is as of 2023. So what does this all mean in regards to the political election? So go out on a limb here. I'm going to make some forecasts. I don't like always to do this, but I'm going to go ahead and do it. Trump has talked about the idea of returning tariffs, and tariffs are one of his favorite methods to use. A lot of people believe that tariffs will help shift everything back into the United States. Basically nearshoring or onshoring industries that have been lost overseas. But remember, the reason we have global shipping is because when you move something across the oceans, the transportation cost is almost invisible. If you haul a container load of sneakers across, the value of transportation by sea of a pair of sneakers is like $1. It's less than that. It's a fraction of that. Now, where it becomes incrementally more is large volume items like furniture, cars, things like that. That becomes a lot more expensive. When you start throwing tariffs on, you can start seeing that. It depends on what you throw the tariff on. If you're throwing tariffs on cars, that's going to appear very significant because it's going to be a major issue in the value of the vehicle coming across. If it's on smaller items, you probably won't see that much of a change in it. The problem is, what do you want to protect in the United States? Let me be clear. You cannot be 100% self-sufficient today. I'm a historian. I teach about ancient civilizations. Ancient civilizations weren't 100% self-sufficient. Trade is one of the key facets of history. And so we have to have trade. And the question is, where do you target your trade? Now, obviously, the issue with China has to do with, is China taking too much of U.S. trade? We've willingly gave it to them. Let's be clear about it. But now do we want to try to pull some of it back? On the Harris administration side, Harris administration has not been very clear. And I don't mean that being derogatory. There hasn't been a lot of policy coming out, especially trade policy coming out. If they continue the same way that the Biden administration does, they're still continuing with tariffs. There is a question about whether or not this will be an improvement. We're seeing big changes about to happen in the container industry. Come February, we have the new alliances coming into place. We're going to see a lot of unrest and issues regarding the movement of goods around the ocean. If the Harris administration continues with the Biden administration's policy of hands off in the Red Sea, we're going to see this increased freight going around the Cape of Good Hope, around Africa. If the Trump administration comes in and decides to slam down the Houthi, does that mean we see a return back to normal shipping patterns? These are all the factors that are at play here. And again, it's going to have a big impact in ocean shipping. What is the final say? Do we see a peak and trough? Understand right now what we're seeing on the global shipping fleet is an older fleet. Ships are not being built in large numbers. We're getting a lot more container ships out there right now, but we're not seeing replacement in bulk carriers. We're not seeing a replacement in tankers out there. Cargo is sailing longer distances than ever before. The fleet's getting older. We've got the creation of the parallel fleet with the Russians creating their own kind of Russian fleet out there that's moving goods outside the norm of the Western first world shipping model. So there is a lot in play when it comes to global shipping. And I got to say, the one thing that gets me about both administrations is they're not talking about it too much. The Trump administration did have a desk in the National Security Council regarding shipping, which I thought was a very positive thing. I think having a high-value, high-level person overseeing shipping was really good. They put some people in who had a lot of experience in shipping. However, I don't think they did a lot for shipping. The Biden administration put people into positions that didn't have a lot of experience in shipping, and it kind of shows. It's really hit and miss sometimes who goes in and who is successful at doing shipping. Shipping is a very difficult thing to learn on the fly. At the same time, if you bring insiders in, they don't tend to communicate very well with the outside. I'm going to be really interested to see who goes into some key spots in any administration, who's going into commerce, who's going into transportation, who's going to be heading the Maritime Administration, what kind of appointees do we see going into the Federal Maritime Commission, what happens in Congress regarding this maritime legislation that is now, basically being put on hold until the election is done. So a lot waiting to happen here. I hope you enjoyed today's episode. If you did, hey, take a moment, subscribe to the channel and hit the bell so you'll be alerted about new videos as they come out. Leave a comment, share it across social media, and if you can, support the page. How do you do that? You can hit the super thanks button down below or head on over to Patreon and become a monthly or yearly subscriber. Kept myself out of politics, did the best I could to avoid getting into that quagmire that is politics. I will just say one last note about political elections, especially a presidential election. This is the most significant presidential election in history until the next one. You'll hear that all the time. I teach history. Unless 7 states secede from the Union, this is not the worst election we've ever had in history, no matter who wins. Remember that. Okay? 1860 election, worst election we ever had. Had a civil war. 750,000 people died. That is the worst election we ever had. That was a 4-way race between candidates. That was a mess. I teach an entire course on the Civil War. Believe me, that is the worst election we've ever had in history. The 2024 election may be gnarly and may be all over the place, but it's going to be hard to measure that it is the worst election in history, unless we have a civil war, in which case I'm wrong, but it doesn't matter. It's the worst thing that ever happened. Till the next episode, Sal, signing off. On today's episode of What's Going On with Shipping, we talk about the world's most contested choke point. That's right, the Bab el-Mandeb. I'm your host, Sal Mercogliano. Welcome to today's episode. So, for almost a year now, we have been talking about the Houthi attacks against commercial shipping in and around the Red Sea, the Gulf of Aden, and that magical strait that connects the two, the Bab el-Mandeb. We're going to discuss a new announcement coming out from the head of the International Maritime Organization, updates on this region, along with some new information regarding attacks being perpetrated against shipping nearly a year after this all started with that dramatic attack on the Galaxy Leader back on November 17th of 2023. If you're new to the channel, hey, take a moment, subscribe to the channel, and hit the bell to be alerted about new videos as they come out. So here we have this story over at G-Captain Mike Schuller. Red Sea Crisis. The IMO, International Maritime Organization Chief Secretary General Ernesto Dominguez, calls for urgent action as Houthi attacks threaten global shipping. I really have to raise a question with the IMO about urgent action. We're a year into these attacks, and now we're calling for urgent action. I think we need to reset the IMO watches. I know we just set back an hour here in the United States for daylight savings time, but it appears as if the IMO may be a year behind. The crisis began with the attack on the Galaxy Leader, as we mentioned before, but the attacks have gone on since then. To date, we have 4 fatalities, 2 ship sinkings, the Ruby Mar and the Tudor, along with attacks on at least 105 vessels. According to Secretary General Dominguez, the continuous attacks on ships and seafarers in the Red Sea are endangering innocent human lives, affecting the entire shipping industry and therefore global security. Global economy. Let's be clear. The Houthi are attacking ships they initially said were connected to Israel. Galaxy Leader, perfect example. Owned and operated by ray carriers. A pair of Israelis own the vessel. So they attacked that ship because of the Israeli attack into Gaza, which again was caused by the Hamas attack out of Gaza into Israel, which we can go back to 1948 and the partition of Israel. We could go back 5,000 years to the Babylonians and the original Israelis. This is the way this conversation usually goes, and I'm sure it will be in the comments down below. However, the Houthi attacks have broadened out since then. They've attacked ships that have no connection to Israel, and as a matter of fact, as we'll see here, they are making allegations of new attacks with ships that are not even connected at all to Israel. What has been the impact of these attacks? Well, let's go ahead and look at some charts. These are vessels at the Suez Canal as of the beginning of January of 2023 up until the present day. Can you tell on the chart where the Houthi attacks started? Yeah, right here, the big huge cliff where we saw the weekly transits go down from about 220 ships a week down to about 120 ships per week. When you look at the percentage and change of year-to-year transits, overall transits are down 40%. In terms of car carriers, almost 95%. Containers over 50%. Crude tankers just about 30%. Dry bulkers 40%. LNG carriers 80%. LPG, liquefied petroleum gas tankers 30%, and product tankers 25%. The magic number here is $100 million. If your shipping cargo is worth more than $100 million, you're going to divert around Africa, because at a roughly 1% war risk insurance cost, it is more economical to take your ship around Africa than it is to sail through, pay for the Suez Canal toll, and risk your vessel. Understand, the issue here really isn't risk. no one's really concerned about the Houthis hitting things because they don't hit things too often. They have, but we talked about 100 ships over the course of a year, talking about 17 to 18,000 ships usually go through the Red Sea annually. So it's a pretty low percentage of ships going through. Plus, we are seeing escorts going through. The European Union's Operation Aspides is escorting certain vessels through. CMA CGM has the Phoenician Express going through. But what we're seeing right now are indications that this may be going on a bit longer. This story from Reuters: Houthis say they will not end Red Sea blockade. Yemen's Houthis said on Sunday they will maintain their maritime blockade against Israeli vessels in response to intelligence information regarding Israeli shipping companies selling their assets to other companies. The Iran-aligned Houthis have said that they are intensifying their attacks to support Hamas and Hezbollah in their resistance against Israeli actions in the region. Now, understand the Houthis have expanded their attacks. They've gone through a series of phases. They started attacking U.S. and United Kingdom owned vessels, ironically because the U.S. and U.K. were defending vessels that were attacked by the Houthi, including U.S. UK owned vessels. And so they initiated attacks against the Houthi. Now the Houthi say they're going to attack more U.S. UK vessels. This is, if you're confused, don't be alone. This is what the Red Sea has turned into. Then the argument is any ships that are connected at all to having gone to Israel, this is the 6 degrees of separation that the Houthis use as their argument. They're saying we're going to attack them. They've attacked vessels, for example, whose companies have sent ships into Israel at some time in the past, and therefore they target them. And then you get this story out over in Maritime Executive. Houthi forces threaten to target ex-Israeli ships even after recent. The story has this statement from the Houthi spokesman, Yahya Saree, my favorite guy in the world. I just, when he's at that podium, clutching that podium in his outfit, he's going to smile a little bit more. He's a bit dour guy. But he said the group believes Israeli shipping interests are taking steps to hide their ships' true ownerships in order to evade the punitive measures that Houthi forces have imposed in the Red Sea. He goes on to say, the Yemeni armed forces will not take into consideration any change in ownership of flags of the ships of the Israeli enemy and warns all concerned parties dealing with these companies or ships are subject to punishment. This is also a fantastic way for them to target any ship that they don't know the ownership over. Quite a number of ships attacked by the Houthi that have no connection whatsoever to Israel, the United Kingdom, or the United States. According to the UK Maritime Trade Office, along with the Joint Maritime Information Center, about 55% of all ships that have been attacked by the Houthi, no connection to either of those three. And those ships that are just connected to Israel, about 29%. So, 3 times out of 10, the Houthi are targeting ships that are connected to the Houthi. Now, we're talking about trade disruptions. We're talking about issues with ships going longer routes around Africa. Surely the shipping companies are in arms about this. No. This story, Maersk rides wave of strong demand and Red Sea disruptions. Mike Scholler, G-Captain, Maersk, the global shipping giant, has reported strong third quarter performance, driven by the strong market demand and ongoing instability in the Red Sea. The preliminary Q3 third quarter results are in, reporting a revenue of $15.8 billion and an EBITDA, I know there's a way to say that, and I never get it right, of $4.8 billion and an underlying EBIT of $3.3 billion, all significantly higher than the year's figures. That's basically profits we're talking about there. Vincent Clerc, the CEO at Maersk, said this quarter we once again supported our customers through times of high volatility and low visibility. We reaffirmed our commitment to profitable growth and operational progress, driving results across all business areas through continued rigorous focus on cost discipline, productivity gains, and efficient asset utilization. Let's be clear. The ocean carriers are not upset about the diversions around the Red Sea. They are putting more ships on service. Remember, they were about to have a glut of shipping out there. This has jacked up freight rates for them. They are doing very well. The Q3 has been phenomenal for them. And what we're seeing right now is that there is really no demand to do that. Matter of fact, Maersk and Hapag in their new Gemini Corporation have just put out their proposed routes, and all of their routes are going around Africa. The only major container lines that are going through right now are select ships of CMA CGM because they're getting the protection afforded to them by the Marine Nationale, the French Navy, and the European Union. Now, I should note that not all navies are even sailing through this region. The most disturbing story was this one. John Conrad wrote this over at G-Captain. The Red Sea is now so dangerous, even NATO warships are avoiding it. The Red Sea, once one of the world's busiest, most strategically vital waterways, has become so hazardous that the German Navy is steering clear. A German frigate, the Baden-Württemberg, and its support ship, Frankfurt on Main, great names, German names, are going around the Cape of Good Hope on their return from the Indo-Pacific deployment, and that speaks volumes. Now, the German Navy is making the argument that Baden-Württemberg is not designed for air defense, so therefore they don't want to send it through. But this is a bad, bad image. The fact that the Germans are not sending ships through this, German naval vessels through this area, is bad enough. The U.S. isn't sending vessels through this area. Commercial vessels or ships of the Maritime Security Program. Yes, U.S. naval warships are still sailing and transiting the area, but not commercial vessels. But here we have the German Navy not sailing through, and that is not a good look. That is 9 for the German Navy. At the same time, a question I get asked all the time is like, hang on a minute, Sal. The Europeans should be worried about what's going on in their backyard, but you know who should really be worried about this? Egypt. Egypt should be worried about it. Well, Egypt reveals a $6 billion revenue hit as the Houthis vow to up campaign against shipping. Now, there was just an announcement the other day about the Egyptians and the Saudis putting together a naval force to patrol the northern Red Sea. However, you are not going to see the Egyptians and the Saudis go against the Houthi. The question is why? Sal, if the Egyptians are losing $6 billion, understand on a yearly average, the Suez Canal produces $10 billion for the Egyptians. Why are they not doing anything? Well, a couple of reasons. Number one, Egypt is one of the few countries in the world that recognize the Houthi as a legitimate government. So Egypt can't really go against the Houthis. Second, Egypt has Gaza on its border. This is the region that the Houthis are upset about because the Israelis are going in, bombing the area, and killing people. And, again, I'm not going to get into the politics here because, Hamas has abducted people. The Israelis are bombing, civilian areas. This is a nasty conflict. This is war. It is absolutely horrendous. But Egypt is not going to go attack the Houthis because if they attack the Houthis, then they appear to be on the side of the Israelis. And with Gaza on their border, that is not a look the Egyptians want. More importantly, they don't want Hamas targeting Egypt. All Hamas would have to do is turn some of their rockets 180 and start raining rockets on the Suez Canal. And while the Egyptians are losing $6 billion, they're still making $4 billion. They don't want to lose that last $4 billion. And so Egypt's got to be very careful. Plus, Hezbollah up in Lebanon, Iran, they don't want targeting of the Suez Canal. Egypt needs what ships are coming through. You're still getting 60% of the vessels going through the Suez Canal, arguably the lower tiered vessels, not the high-end vessels. You're not getting the large vessels, expensive vessels over $100 million going. But Egypt has got to play a very careful, measured response here. At the same time, the Saudis, who have fought the Houthi for 10 years, don't want to get back into that mess. And so they're avoiding it. So all of this is a mess. Add to it, hey, let's throw another player into this. Let's throw Russia. This story over in the Wall Street Journal, Russia provides targeting data for Houthi assault on global shipping. Moscow's assistance in attacks that are disrupting trade shows how the Kremlin's seeking to tie up the U.S. in the Middle East. I'm going to have a link to that story. It's a great story for you to take a look at. But when you get down to it, it is vital. Russia provides targeting data for the Yemen's Houthi as they attack Western ships. Goes on here, the assistance, which hadn't been previously reported, shows how far Russian President Putin is willing to go to undermine the U.S.-led Western economic and political order. Russia, in this case, supporting the Iran-backed Houthis, which the U.S. designated as a terrorist group, as they carried out a series of attacks in one of the world's most heavily traveled shipping routes. The Russians providing targeting information to the Houthi is key. We know that they were getting information provided by Iran for a long time. We saw Iranian vessels, the Pashad was in the region, but now we're getting the image that the Russians are providing this. And what we do know is a lot of Russian ships are sailing through this region and are able to pass. Now, sometimes the Houthi do hit Russian ships, let's be clear. I think that goes more to the fact that the Houthi don't know who they're shooting at sometimes. But we do know that this is in the advantageous position for the Russians because of support that the U.S. and the West is giving to Ukraine. This is a way for Russia to hit back at the U.S. Plus, you have the G7, the EU, doing economic sanctions against Russian shipping. You've got price caps on diesel and oil. You've got the creation of the shadow parallel fleet that's going on. We are really not paying attention to the maritime dimension of the war that is being fought here right now. The conflict in and around the Bab el-Mandeb, the conflict up in the Black Sea, even what China is doing out in the South China Sea. This is all part of a larger issue regarding freedom of the seas and navigation. The other element of Russia goes back to an allegation that came out very early in these attacks, way back in January of 2024. This story over at Qvcgp, Houthi bribe allegations rock the shipping market. There were allegations put out by Shipping Watch, which is a Danish maritime news service, that was talking about that some of the shipping firms may be paying off the Houthis. Now, this was immediately denied by the major shipping firms. Everybody said that we weren't doing this. This is not happening. We're definitely not doing it. I reported a few months ago looking at tracking of vessels coming through the Red Sea. Now, these are not the major shipping lines. These are Russian ships, Chinese ships. There was an indication that ships were stopping before going through the contested area, both the southern Red Sea and the Gulf of Aden. I was hearing rumors from many sources that I would tell you are very good sources that Russians and other shipping firms were paying off the Houthi. They were literally waiting for boats to come out and dropping bags of money into it. Well, guess what? We get this story over in Lloyd's List. Houthis' threat to shipping growing thanks to unprecedented network of support. Houthis reported to be earning an estimated $180 million a month from illegal safe transit fees paid by unnamed shipping agents to secure safe passage through the Red Sea. Richard Mead over in Lloyd's List has this story outside the paywall so you can take a look at it. The threat posed to global shipping lanes by the Houthi is growing dramatically thanks to an increasingly diverse network of political alliances, military suppliers, and financial support networks. Goes on, according to a UN panel of experts report seen by Lloyd's List, the Houthi have benefited from training and technically helped by the Quds Force, the foreign operations arm of Iran. Financial networks now extend across multiple jurisdictions, including Djibouti, Iran, and Turkey, using various banks, shell companies, financial facilitators, and shipping companies. Houthi spokesman announced on Sunday that the Yemen rebel group would maintain its maritime blockade against Israeli shipping in response to intelligence information regarding Israeli shipping companies selling their assets to other companies. The UN panel of experts said, which had been circulated among government intelligence services by the UN Security Council, but has not been made public, also confirms recent intelligence indicating that the Houthis are strengthening ties with the resurgent terrorist group Al-Qaeda in the Arab Peninsula and Al-Shabaab in Somalia. So, the gang's back together again. All the old ones we saw during the global war of terror are now coming up into this area. Now, the UN report looked at the period from September of 2023 up until July of 2024, and they're making the allegation that there's a lot of effort going into these attacks. It's more than just the Houthi shooting missiles. It is intelligence networks, it's terrorist organizations. And let me be clear, I am always suspicious when we start sounding the terrorist siren. I live in the United States. I've watched 20 years of conflict in Iraq and Afghanistan. But what we do know is that shipping is being targeted, and the amount of attacks being done right now are sufficient enough to drive most of shipping out of the Red Sea, the Gulf of Aden, the Bab el-Mandeb, around Africa. What is going through the region, 60% of the shipping that's remaining, tend to be local shipping and shipping that is earmarked for Russia, China, India, Iran, basically the non-aligned states. If you're a member of the G7, the EU that are imposing price sanctions, if you're part of the alliance of the United States against the Houthi, your ships are being targeted. And most importantly, if you're Israeli, you're being targeted. That's what we see. We're definitely starting to see this issue, and I've talked about it repeatedly here, about the freedom of the seas being challenged. Go back to this Lloyd's List report. While the UN panel has not been able to independently verify this information, sources estimate that the Houthis' earnings from these illegal safe transits may be about 180 million per month. The alleged payments of fees is not direct interaction between the growing Houthi operation and shipping companies. According to the report, the Houthi-controlled companies are importing oil and liquefied petroleum gas using false country of origin certificates through the ports of Yemen, sometimes bypassing inspections by the UN verification and inspection mechanism. It occurs in two ways. Some vessels travel to specified countries, turning off their AIS transponders, while others conduct ship-to-ship transfers at sea without violating the ports indicated in the country of origin. I still think there are bags of money also being tossed off to pay off. Overall, the UN panel concludes that Yemen's Houthi rebels are transforming themselves, quote, into a powerful military organization due to unprecedented military support from outside sources. The danger here is not the Houthi, is that this can be happening in other maritime choke points around the world. What happens if there's a group in Malaysia, Indonesia, the Philippines that want to choke off the Malacca Strait where 23% of the world shipping goes through, or the Sunda or the Lombok Strait or the South China Sea or any other kind of narrow little waterway? Right now we're seeing it being done in the Bab el Mandeb. Cheers. This is the concern we should be having. All those factors are playing in. We're a year almost from the seizure of the Galaxy Leader. And unfortunately, what we've seen is really a disjointed, disorganized response to the Houthi. You had the U.S. going strong, Eisenhower Battle Group, USS Carney, USS Mason, going in and whacking drones out of the air left and right, shooting $1 billion worth of missile and ordnance into the air until the Eisenhower had to go back home and redeploy. And the decision was made, we're going to turn this over to the European Union, Operation of Speeds, which is a handful of lesser capable warships and vessels. And basically what they're doing is feeding several ships through on convoys. For the United States, since January of 2024, no U.S. flagged commercial vessels have gone through the region. They are being diverted around. You've got the German Navy sailing around. This is not good. You are allowing the Houthis to claim ownership over an area of international waters that, under UNCLOS, the UN Convention on the Law of the Sea, Article 19, is the right of innocent passage. There's no question that innocents are being killed. Innocents are killed in war, in every war in human history. However, the issue here is whether or not the Houthi, who are not the recognized government of Yemen, I know they own the capital, and I know countries have recognized them, but the UN and many countries around the world don't recognize them. They're alleging that they have control over that region, and they don't. However, there are areas of the world's ocean that other nations are claiming too. The Danes are arguing that they have the right to inspect vessels coming through the Danish Straits. The Turks have that weird relationship with the Turkish Straits under the Montreux Convention. Even the Canadians are making arguments over the Northwest Passage that they control. Some places make claims over pieces of waters that they don't have claims over under international law. And you could mock international law all you want. I can mock the United States and UNCLOS with the best of them. The U.S., which helped pass UNCLOS, never ratifies it. We should. Can't get 67 senators to ratify it. I don't know why, because they're worried about losing U.S. sovereignty. I understand it, but it's a ridiculous argument. You're not going to lose U.S. sovereignty or mining rights or drilling rights. It's not an argument that's worth it. However, what we're seeing now with this contention in this region, we may see it amplify and increase in other straits around the world. The Iranians are making claims over the Straits of Hormuz for years now, for decades. Now the Houthi over the Bab el Mandeb. And again, if you see the Straits of Malacca, other key maritime choke points come under attack, that is going to impact global shipping. That impacts the world. And right now, the Houthi are impacting the West by driving freight rates up, by making shipping more expensive than it was, impacting inflation, all the things that a non-state actor should not be able to do. In the 18th, 19th century, this is piracy. We dealt with piracy with the Barbary pirates. Many nations dealt with the Barbary pirates. Many nations dealt with piracy. Romans dealt with piracy. Everyone dealt with piracy at one point. This is the 21st century. piracy going on. Houthi are attacking ships, killing merchant mariners, 4 of them, sinking 2 ships, and imposing extra costs on the world. I hope you enjoyed today's episode. If you did, hey, take a moment, subscribe to the channel, and hit the bell to be alerted about new videos as they come out. Leave a comment, share it across social media, and if you can, support the page. How do you do that? Hit that super thanks button down below, or head on over to Patreon and become a monthly, yearly subscriber. If you're the Houthi, I have a 10% bonus for you if you join Patreon now. I'm just kidding. I have nothing for them. Nothing at all. Not giving you any at all. So next video is Sal, signing off. On today's episode of What's Going On with Shipping, the Port of Vancouver is in the midst of a labor dispute. Sorry. I am your host, Sal Mercogliano. Welcome to today's episode. My apologies for getting late to this. This has been going on for a few days, but there's been a little bit of an election here south of the 49th parallel. It's kept everyone busy, at least in the United States, maybe even the rest of the world. But doesn't excuse me for not getting to this, because this is of utmost importance to everybody in and around Canada. A labor strike / lockout, we'll talk about why this is both a strike and a lockout in a minute, has embroiled the Port of Vancouver, but it's having impacts not just in Vancouver, but across the British Columbia and actually across the rails and all the way to the eastern shores of Canada. We're going to break this down, tell you what's happening as of today and what we can expect to see happen in the future. If you're new to the channel, hey, take a moment, subscribe to the channel and hit the bell to be alerted about new videos as they come out. This story over at FreightWaves: lockout stalls more container ships outside Western Canadian ports. Union contract fight has halted container handling. Story goes on. Container ships continue to line up outside Canada's busiest import gateway as carriers wait for a lockout of union longshore employees to end. On Monday, 704 persons represented by the International Longshore and Warehouse Union, the ILWU. This is the Canadian version of the ILWU. Remember, we had the port negotiations between the ILWU and the Pacific Maritime Association on the West Coast. We are in the midst of issues on the East Coast. That is the ILA. That is the International Longshoremen's Association. But in this, the ILWU Local 514 was locked out by ocean carriers and terminal operators represented by the British Columbia Maritime Employees Association, the BCMEA, at the West Coast ports of Vancouver and Prince Rupert, after the union rejected what the employees group said was its, quote, final contract offer. The union also is objecting to the introduction of automation in port operations, very similar to what we saw going on the East and Gulf Coast ports with issues over automation and obviously pay. This story over at Maritime Executive. Vessels pile up as foreman lockout continues at Canada's West Coast ports. The BC Maritime Employers Association told the Canada Press there's been no engagement with the local representing the foreman or federal mediators since the lockout began Monday afternoon. The employees continue to blame the local for calling a strike, while saying the offer they presented is the same as what the Longshoremen Union accepted in July 2023. They have also added provisions to address the foreman's issues, while saying it does not require any concessions of the union, nor to waive the technological change notice provision. The association representing the employers has repeatedly called this is its final offer in the contract negotiations that date back to March of. They, however, said without qualifying that the employers may be required to reassess their position on the current offer. The strike is impacting all the container terminals included in Vancouver, which accounts for 40% of the cargo movement in Canada. General cargo and some bulk are impacted, but not grain or cruise ships. The story I want to reference as I show you what's going on in Vancouver is this story over in Lodestar. Canadian forwarders extremely frustrated by lack of action to end port strike. This is the Port of Vancouver, brought to you by Marine Traffic. These are the ships destined for the port. In the story from Lodestar, the Director of Policy and Regulatory Affairs for the Canadian International Freight Forwarders Association told Lodestar, quote, both ports on the West Coast and 40% of capacity at the Port of Montreal She added, the railways have placed an embargo on moving containers to these locations. The Port of Vancouver says it remains open and we continue to manage high demand for our anchorages. The port goes on, this includes working closely with industry to maintain fluidity by optimizing anchorage utilization and prioritizing anchorage assignments to terminals that remain open. Centerm, Deltaport, Fraser Surrey, and Vanterm container terminals are all impacted. As of yesterday at 6 a.m., anchorage utilization at Vancouver was at 85% and at Southern Gulf Island 63%. And Vancouver Fraser Port Authority warned that there was limited anchorage capacity. Vessels currently anchor outside Port Authority jurisdiction include the Eversteady, Marcos 5, SM Qingdao. They're all located here off of Victoria right now. According to Hapag Lloyd, yard utilization at Prince Rupert is low at 63%. Import ground counts are low and dwell times are approximately 1.8 days. Meanwhile, negotiations between the Maritime Employers Association and Dock Workers Union, CUP Local 375 on the Canadian West Coast, are ongoing, but, quote, the Montreal Port Authority is not at the bargaining table. Operations at Montreal have been halted since 31 October. The dispute centered on the two container terminals operated by Termont, which handles some 40% of volume. Story goes on, we are frustrated with the lack of progress across all parties. Freight will have to be diverted to functioning ports in Canada and the U.S., but even this contingency leaves shippers and forwarders with few options, especially when considering the looming January deadline for the threat of renewed U.S. East and Gulf Coast dock workers strike. So obviously a lot of turmoil going on both the East and West Coast of Canada, Port of Montreal, Port of Vancouver. Let's go take a look at what the Port of Vancouver is saying directly. Let's take a look at the 4 notices put out by the Port of Vancouver regarding this event. They expect disruptions to begin at 0800 Pacific Standard Time on Monday, November 4th. The ILWU Local 514 issued a 72-hour strike notice, followed by the BCMEA issuing a 72-hour lockout notice. Hence, this is both a strike and a lockout. The BC coastwise labor dispute will impact operations at members' terminals where Local 514 is employed. At this time, we expect grain and cruise operations, along with operations at the West Shore Coal Terminal, to continue at the Port of Vancouver. This is the November 4 update on the story. A coastwise labor dispute involving the ILWU and BCMEA is impacting operations at some Port of Vancouver terminals as of today. The November 5th notice continued the same. The most recent notice comes out November 6th. I want to take a moment and take a look at this. There have been no changes to the coastwise job action involving ILWU Local 514 and the BCMEA. Port of Vancouver remains open, and we continue to manage high demand for anchorages. When you look at the different sectors here, the auto sector operations are impacted, break bulk is impacted, bulk sector, grain operations and operations at West Shore Coal Terminal have not been affected. They continue to move goods. Most petroleum products also continue to move. Operations for other commodities are impacted. On the container sector, Centerm, Deltaport, Fraser Surrey, and Vanterm container terminals are impacted. The cruise sector is not impacted because the cruise season ended on October 29th. Rail, there are embargoes in place, meaning there's no rail movement either in or out of the anchorages. Rail has embargoes in place, meaning there's no movement of rail in and out of the port. There is currently limited anchorage capacity at the port due to recent inclement weather and seasonal demand, including grain exports being in their peak shipping period. And you saw that with the ships anchored directly off the Port of Vancouver. This is the notice from the Port of Montreal, October 31st. This morning at 11 a.m., an indefinite strike began at the Vieux and Maison Nouveau terminals in accordance with the strike notice filed by CUPE Local 375, the Longshore Workers Union. As a result, these two Termont-operated terminals are closed and no rail, truck, or ship service will be provided, with 40% of total container handling capacity paralyzed by this workers' stoppage. And ships and trains already obliged to choose other routes, the Montreal Port Authority expressed its deep concern about the negative repercussions of this work stoppage. So we have a stoppage in the port of Montreal. We're seeing no containers moving into the port through that. About 40% of the total container handling capacity is out for the port of Montreal. And now we have Vancouver, Prince Rupert, and British Columbia that is out. This obviously impacts Canada greatly. Add to it, rail is not coming in there. Story I should have gotten to sooner. My apologies. Obviously, this is crucial for what is happening in Canada. Hope you found today's episode interesting. If you did, hey, take a moment, subscribe to the channel, and hit the bell so be alerted about new videos as they come out. Leave a comment, share it across social media, and if you can, support the page. How do you do that? Hit that super thanks button down below, or head on over to Patreon, become a monthly or yearly subscriber. We will keep you up to date on what's happening up in Canada regarding the strikes, along with everything else that's going on around the world, like there's not enough going on. So next episode is Sal, signing off. Hey, what's going on with shipping? Sal Mercogliano here with our week of live interviews with people I think you're going to find really fascinating. This week, we start off with Jay Mintzmeyer. We're going to have on Bruce Jones from over at the Brookings Institute. And then we're going to throw on at the very end here with John Conrad, talking about news and what's going on with shipping. So there is a lot going on, I'm not going to lie, when it comes to shipping. And I couldn't think of anybody better to have on board to start us off this week than Jay Mintzmeyer. Jay Mintzmeyer has been a supporter of this channel for a long time. And I've had a chance to know Jay for a while. So it's a pleasure. I'm going to bring him on right now with us. There he is. First off, Dr. Mintzmeyer, it's such a pleasure to have you on. We can just keep calling each other doctor the entire time and be absolutely annoying to everybody.
Yeah, absolutely, Sal. It's great to be on here today. Thanks for having me on your channel. It's always great, and lots of stuff going on. So I'm glad you picked this week to do these interviews because just such a dynamic situation.
Well, it worked out for us to be this week, so it actually worked out pretty advantageous for us. Hoping you're having a great Christmas, and I know everybody here is having a great Christmas. But we got an hour here. I want to jump right into it, right off the bat. So, Jay, you're going to talk to us about stock and what's going on with shipping. And I don't even know where to begin, Jay. I really don't, because we can do containers, we can do bulk, we can do tankers. I will let you decide where you want to go on this.
Wow, an open-ended pathway. All right, well, this is gonna be a great discussion. As far as I'm tracking, we're here for about an hour total, and I think we have time at the end for Q&A. So if folks have any questions, feel free to type them in the chat functionality, and we'll try to get those at the end. But yeah, what a wild year, Sal, and it's really more of the same. I mean, it's been a wild 3 or 4 years. Ever since COVID, even before COVID, there was crazy things going on with shipping. But the last than usual. We have the Russia product and diesel and oil sanctions ongoing throughout 2023. And then just when we thought things were starting to normalize, we got a drought situation in the Panama Canal that's sort of been under a lot of folks' radars, I believe. And then very end of November, early December, we started getting disruptions and some attacks in the Red Sea outside the Suez Canal. And of course, that has exploded onto the mainstream. Lots of folks started talking about it about a week ago, 10 days ago, and the stocks have been gyrating up and down and all over the place. So yeah, there's a lot to talk about, Sal. We've also had a lot of interesting press releases and different sort of narratives from these companies over the past few days as well. And just in time, for the Christmas holidays, we had the market closed on Monday, and now we sort of normally the 26th, the day after Christmas, is just such a boring day in the markets, right? I mean, and normally that's, the folks who kind of forgot about it are getting their tax loss selling done. A few folks are doing the final touches on their end of the year positioning. And this is probably the most interesting and the most exciting last couple of weeks in December that I can ever remember, Sal.
I can't think of any either, Jay. I mean, with everything going on in the Red Sea, I mean, you have the Red Sea and the attacks going on, massive diversions of containers and tankers. We're seeing low levels in the Panama Canal. I think you got to go back to the 2020, 2021, 22 supply chain disruptions to really see where this is been going on in a level of disruptions like this. I mean, it's global. It is a global disruption. When Maersk announced that they were pulling out and it started the domino effect there, we've just seen everything across the board go. So I'll pick one for you to start, and that'll be containers, because you have been the master of Zim for a long time, and for those who don't know, Zim is the Israeli-related container ship company, 10th largest in the world, and obviously a big target going on. But in containers in general, of course, not just Zim. But what's your take been so far on what's going on with containers?
Well, big picture, Sal, with containers, we had such a disruption in 2020 with the COVID shutdowns and then the rapid reopening, right? And we had all the consumer stimulus across Europe and the United States. And folks remember what happened. Shipping rates went absolutely ballistic. And those shipping rates went ballistic primarily for two reasons. First of all, we had port congestion across the United States and Europe, primarily in Los Angeles. I mean, it was an unprecedented amount of port congestion. And at the same time, we had this huge amount of consumer demand. So you have consumer demand going up and you have supply artificially low because of the congestion and those other issues. And of course, rates, supply and demand, right? So the rates went ballistic. And then we had just massive ordering of ships because the liners realized they were undersupplied and the consumer savings ran out. And so, of course, then we had the boom and bust of markets like we normally see. And from late 2022 throughout 2023 was kind of a bust scenario for most of the container ship markets. Well, that started to change about 6-7 weeks ago. And a lot of that was being driven, again, both supply and demand. On the supply side, the Panama Canal drought was starting to worsen. The amount of ship transits were reduced. And in the United States, we finally had year-over-year inflections in consumer demand. When inflation is starting to calm down in the United States, job markets have been very healthy. Consumers were returning to the stores over the Black Friday holiday into Christmas. And now, most recently, we're having all this news flow around the Suez Canal and the Red Sea. So it's not as extreme as we saw in mid 2020 through 2021, right? It's not that epic of a demand surge, and it's not anywhere near as epic of a supply disruption, but we're seeing similar inflection points on both sides of the trade. Demand is very strong. Consumer demand is extremely healthy. The percent change is not, skyrocketing like it did last time, but the nominal level of consumer demand is very strong in the United States. And now we're seeing the Suez Canal issues. And just to bring folks' memories back to 2021, we had a pretty tight container ship market, and we had the Ever Given get stuck in the canal. And I know, Sal, you were all over that story, but that was just a few days. And those couple days of disruption in the Suez Canal led to 2 to 3 months or more of knock-on effects. And so what we're seeing now is not a Suez Canal closure, right? It's just safety diversions, things like that. But this is probably not going to last 3 or 4 days like the Ever Given. This could go on potentially for months. So it's not a full 100% closure, but it's also a much longer lasting impact. So that I think is very interesting for the container ship story. Zim is ultra levered, and I have a long position in Zim again. I bought some in November as it seemed oversold, so I got to disclose my positions and pump my bags and all that sort of thing. But I do have a position in Zim. It's fairly modest. It's pretty small part of my portfolio. But Zim is ultra levered to the spot rates in shipping. So they're one of the companies that is positioned potentially, if container freight rates keep going up, Zim's going to do really well. And Zim's also ultra shorted. The short interest is right now pretty much, I believe, at an all-time high. And so that's a very interesting dynamic. Zim's not really one of my favorite positions at this point. It's a small position of my portfolio, but that's one way where I am sort of positive or favorable on the market at this point.
A couple of things real quick, Jay. Just a small technical issue, getting a little bit about sound on your side. I'm not sure if your mic is fully up or not, just a little bit. And so just may want to check that real quick. I do think the issue on the containers, and as you mentioned with Zim, it's really interesting. Obviously, they're at a low right now of where they've been, I think even prior to the IPO, but that's been a downward trend we've been seeing. But again, there's not a lot of publicly traded container firms out there. One of the things we have talked about in the past, I know we talked about this last year, was a lot of the ancillary companies. And there's been a lot of movement in that sector too regarding container ownership and the container lessor sector. I was wondering if you could talk a little bit about that too, and what's your view on what's going on. That obviously had a big deal in that sector over the past year, and what's happening with it going forward.
Yeah, absolutely. And I turned the mic up a little bit, so hopefully that's coming through a little bit more clear now. But on the liner side, yeah, there's not too many publicly traded positions in the United States. There's Zim, and there's another one called Matson, MATX, which is primarily focused on more protected U.S. domestic trades. So they're primarily doing things like Puerto Rico and Hawaii and Alaska and stuff like that. So those are really your only two sort of liner stocks that you can get direct access to in the United States. Maersk, of course, is traded in Europe. Hapag-Lloyd is another name, but those are a lot more thinly traded and only in Europe. As far as some of the related trades in containers, one of my favorite sectors for a while, Sal, and I know we've talked about this before, was the box lessors. And those are the financing companies, and I've talked about this a little bit before. They're really more almost like banking plays, and they own those 20-foot and 40-foot container boxes, and they lease them to the liners, and that provides 6, 7, 8, 9 years of guaranteed cash flows. So those were companies that I loved. But sadly, Sal, well, I don't want to say sadly because it's a success story for investors, but both of those companies have now been taken over, have been taken private. So apparently private equity, massive private equity firms agreed with us. We had Stonepeak and Brookfield, respectively, step in and buy out Textainer Group, TGH, and Triton, TRTN. So those companies are really no longer among us. So I'm disappointed because those were phenomenal companies, phenomenal investments. But I am pleased because I think it was a complete validation of that thesis. Now, those are the boxes. Very simple, right? More of a financing play. Now, there's also companies that are similarly structured that own the vessels, the ships themselves. Now, this market looked like it was going to start getting oversupplied. There's a massive order book coming in and throughout the end of 2023, and especially throughout 2024, massive deliveries. But anytime you have a disruption like we're seeing with the Suez Canal and the Panama Canal, you're going to need more ships to handle the same amount of cargoes. So that significantly changed the potential supply demand dynamics into 2024. So there's a lot of companies that own these ships and will benefit from leasing them to the liners. And it's a more of a lower risk, lower beta way to kind of play this story. And one company that I'm long, and I've mentioned it before in the past, is Danaos Corp, DAC. And that's been one of my top personal positions. Of course, I have a long position. Our models at Value Investors Edge have long positions in Danaos Corp as well. But they lease the ships, these liners. And so that's a way to get sort of a lower beta. If you look at the stock, it's not anywhere near as volatile as Zim, but sort of a lower risk way to play that story. Unfortunately, the box lessors, they're gone. They both been bought out. So that used to be my favorite sort of investment angle, investment pitch. But now we just have to look at the ship owners.
And let me say something about that because you brought that up a year ago. I mean, more than a year ago. I think we talked about it actually the video before that, and I got into that. And man, it was a great investment. It was a good one. It was a really good one. Paid off really well. I got out too early, unfortunately, and didn't net what I should have. But it was still a great one. So I thought that was really interesting to see how that's played out and how that market's been changing. Obviously, we're seeing a lot right now with what's going on in the Red Sea. Jay, let's talk about some tankers. I'll leave it to you which way you want to go. Do you want to go with crude and dirty oil, or you want to go with the clean oil guys? Which one do you want to talk about?
Yeah, I mean, I'm sure we'll have time to talk a little bit about both of those.
Oh, yeah.
I mean, tankers are such an interesting story to me because the setup was already massively bullish before any of this stuff. Before the Panama Canal, before the Suez Canal, before anyone was talking about the Houthis, the tanker investments were looking very, very, very strong. In fact, 2023 was the strongest, second strongest product tanker year in history. And of course, 2022, with the Russian invasion of Ukraine and subsequent threats of sanctions, was the strongest year in history. So we just finished the second strongest, which was 2023. And right before that, 2022 was record highs. Those stocks, especially the product tanker stocks, have not produced enormous returns over the last year. And I think that's because a year ago, folks had really, really high expectations and they set their sort of rate averages and such way too high. They set like impossible hurdles for these companies to clear. And folks were talking about multi-bagger returns and just not being realistic. And then I saw a lot of folks earlier this year making what I believed were erroneous year-over-year comparisons. They're saying, well, that the tanker rates are down 30% year over year. Well, yeah, but they're down 30% year over year against the strongest year in history. And so I think giving those markets a little bit more time to continue to tighten, continue to balance out is the right way forward on here. And the best part about the tankers, Sal, and I know you already know this, but the order book, the forward order book, which is your forward supply, is almost nothing. In 2024, we're going to see the lowest amount of tanker deliveries, especially on the crude oil side, that we've ever seen in modern history. So you have a very tight market. You have disruption starting to come forward, and you have no relief valve on the supply side, no supply. And so that's just a recipe for enormous rates, enormous strength across that sector.
Yeah, I think especially when you start seeing diversions like we're seeing right now, there is not the capacity out there to be able to go those extra ton miles and be able to pick it up. I mean, containers have that slack. I mean, because as you know, and you've talked about with the ship lessees, that they have that ability to get more ships. Container lines can throw more ships on it. They have tonnage coming in. It was a building spree of epic proportions, but it really supplanted any other thing else going on. And because tankers have been so low for so long, when ship owners order new ships when they have profits, and they just have not had those huge amount of cash to be able to do it. And what we see is a very finite tanker fleet out there in both the crude oil sector and the clean sector. So I agree. I think you're hitting on a key topic right there.
Yeah, and I would differentiate a little bit because it's two sectors, but they correlate together, of course. A clean, as you said, being diesel, jet fuel, gasoline, things like that, and the other being regular crude oil. And the crude oil tankers have the most bullish order book that I've ever seen of any sector of any time in shipping, certainly in my career, arguably even my entire lifetime. And like I mentioned, there's no supply growth. And secondly, the existing fleet is the oldest it's been in about 20 years. So not only is there no forward supply, no new ships to replenish the global fleet, the ships that are on the water are getting older and older as we speak. And then additionally, and this is not top of anyone's mind right now because everyone's talking about Red Sea and Houthis, but there are enormous environmental regulations hitting the market. There's something called EEXI, which is a design index for ships. There's a CII, which is a carbon intensity index. And those initiatives started in 2023. But 23 was sort of a baseline test year, evaluation year. And 2024 is the first year where we start to see penalties and restrictions on how fast these ships can move. So the real impact doesn't even start until 24. Each year, 24, 25, 26, 27, those restrictions become more and more stringent. Additionally, in Europe, starting in about a week now, there will be a emissions carbon trading system, which is going to act basically as a tax on these vessels. And the more emissions they have, the higher the tax is going to become. So this will encourage vessels, especially those trading throughout Europe, to move slower and slower in order to become more efficient on the emissions curve. So when you think about the impact of all these environmental regulations, it's going to synthetically, sort of artificially, reduce the available global supply. And there's no new builds coming on to relieve that. So that we were extremely, and I say we, our team at Value Investors Edge, we were extremely bullish on tankers before any of this happened, before the Panama, before the Suez Canal stuff. So this is just extra fireworks at the show, right? And this is just potentially driving stuff even higher. Now, what we haven't seen yet, Sal, and I don't want to jump ahead too much, but we haven't seen anywhere near as many tanker diversions or disruptions around the Suez Canal. It's almost primarily been the container ships that are being diverted. And I think that's just, there's a function of a couple things. First of all, the average cargo value on the tankers is probably 50 million, 60 million, depends on how you price out the products and the crude oil prices. Whereas the average value on some of these container ships can be $2, $3, $4, $5 billion. So a significantly different amount of cargo, which means the insurance premiums price out differently. The customer demands are different. A lot of the end clients of container firms are more risk averse, right? Think about major global retailers, right? They don't want to be associated with potential loss of ship, loss of cargo, loss of life. Whereas some of the commodities, oil, gasoline, diesel, are more controlled by commodities traders who are all sorts of different entities and can maybe more easily distance themselves from any negative effects. And finally, the tanker market is far, far tighter. If tankers start diverting, we're going to see rates go ballistic overnight, whereas the container fleet, as you mentioned, Sal, it had a lot more slack in it. But even that, Sal, even with that slack in the container fleet, we've seen freight futures for multiple routes around the world, out of China, out of Europe, all sorts of places. Some of those have doubled or tripled even in the last few weeks. And so if that's that's what happens to container freight from their disruptions. Imagine the potential we could see in tanker markets if those ships also start diverting.
I think you're exactly right. What you're seeing divert around the Red Sea are container ships. And again, if you're paying 0.7% war risk insurance on the total value of your cargo, that's substantially more for a container ship than what you're doing for a crude oil tanker or even a gas carrier. It's substantially more. And the ships we're seeing hit, ironically, are bulk carriers and tankers, which they can basically absorb the hits actually based on what the Houthi are using. So I think you're right that we haven't seen those big diversions yet. And like you said, we don't have the ships to really support diversion like this. The reason we built super tankers was literally because the Suez Canal closed for 8 years from 1967 to 75. And that's the reason you saw the construction of those massive tankers. But I got to say, again, I'm going to come back to talks we've had where you talked about this market. And I got to say, I think I got into, I had a note up there about TK tankers, talk about TK. You know, I got into TK. I think I bought it like $15 a share at the time. And so it was really low at the time. And so just like you said, I remember a thing you said, it can't get lower. I mean, it's pretty much at the bottom as it is. What are you looking at now for the tankers? I mean, what's your prospects in that area? What are you thinking that's happening? I know it's hard to read the tea leaves and everything that's going on right now because it's just an insane world when it comes to shipping.
Yeah, well, it's always difficult to make predictions, so don't hold me too far to these. But of course, you remember, Sal, we've interviewed and done these discussions in the past, and hold my feet to the fire as it may in a few months.
Well, I tell you what, before I get you into that, Jay, because I do want to hold the predictions to the end. But there was a question that came up, and I want to reference it again: the role of the dark fleet. That we've seen the proliferation of that with Russia, and obviously the dark fleet's this nebulous little thing. How would you gauge the dark fleet affecting tanker sector out there in terms of stocks and what's going on out there? I think you're exactly right about the emissions issues. That's the big issue we're looking at right now. The reason you can't put the hammer down on the throttles for ships is because of emissions, because you're going to get yourself in trouble and you don't want to get that high score on that emissions. And all of a sudden you're doing 8 knots for the rest of the year to make up for that. I think there's a lot of play in that. But the dark fleet seems to be one that's really throwing a lot into the works right now.
Yeah, and that's a great question, Sal. And the dark fleet has had 2 different types of effects. I mean, if we go back to 2022, mid 22, late 22, after the Russian invasion of Ukraine, it was clear that there was massive sanctions on the way, right? And they didn't end up starting until the end of November 22. And the product tanker sanctions didn't end up starting until February of 2023. And in fact, the case study of those sanctions was one of the articles in my recently defended dissertation. So I spent a lot of time looking at this, studying the AIS flows, which are basically GPS for ships, looking at the cargo diversions, looking at those impacts. And there's other folks that have done this as well. So I'm not the end all be all expert on this sort of thing, but strictly from an investment perspective, because that's what we're here to kind of talk about today and talking about our investment research and the stocks and stuff that we follow. The initial impact of the emergence of the so-called dark fleet was extremely bullish for tanker markets, especially for those companies that own the sort of aging, outdated tonnage and perhaps wanted to sell some of that tonnage. And so some of these companies had the opportunity to divest their older ships, the 15-year tonnage, 15-year plus ships that would otherwise be going obsolete. And they had a chance to sell those ships at basically almost all-time record highs for those ships. In fact, in some cases, companies were selling ships. They'd owned the ship for 10 years and they were selling it for more than they paid 10 years previous. So just unprecedented amounts of stuff. And you mentioned TK tankers earlier. TK tankers sold a couple of their ships and they sort of benefited a lot from having an older fleet. And now, Sal, now that we're into the end of 23, so now we're a year and a half along, if anything, the dark fleet has turned to more of a headwind, more of a negative for the tanker sector. And the reason that is because those older ships in a normal market, in a tier 1 market, where we're doing legal trades between major counterparties, oil majors, Exxon, Chevron, Shell, all those companies, direct trade with the United States and other major ports, those ships would either not be allowed to access some of those ports, or they would have to pay a much higher cost to do their surveys, to the dry docks. The oil majors wouldn't even want to deal with any of the ships that are over 15, especially not those that are over 20. But now those older ships have a home in the dark fleet where these surveys and these regulations and these restrictions are not necessarily adhered to as much. So it's kind of funny. The dark fleet turned from a major sort of tailwind positive thing for the sector, and now I view it as net negative. So it's really kind of shifted in that way, because I'd like to see those ships demolished, because if those ships get demolished or scrapped or expensive retrofits are done, that will continue to hold down the supply side.
Yeah, I did a story earlier in the year about a tanker, the Pablo, that blew up off the coast of Malaysia, and it was pretty clear it had to do with the inert gas system not being operative on the ship. This is what keeps the ship safe. And you're right. I think they're running ships way past where they would, which would usually drive replacement value. And as you said, if you're not replacing, and matter of fact, we're seeing ships actually phase out of the dark fleet back probably over into the commercial sector, because again, with oil coming down, you're seeing those ships more, and there's more reduction being against them. We're seeing the Greeks coming against them, a lot more sanctions by the U.S. government against them. So there's a lot more trying to get that dark fleet under some sort of control. But you're doing these ship-to-ship transfers out in the middle of places they shouldn't be doing them. So you're right. I do think that's an interesting argument about where they are in that sector. What about what we're seeing with the reductions from OPEC? And we saw OPEC Plus come down with their reductions. We saw Russia come down with their reductions. How is that impacting the market? At the same time, we'll talk about LNG and LPG here in a second, where you have the U.S. becoming the largest energy producer in the world. And what does that mean for the movement across the sectors?
Yeah, well, both those impacts kind of go in opposite directions at each other. We'll start with OPEC in the order that you mentioned. The OPEC plus cuts are quite clearly going to be a negative, and they have been a negative, a little bit of a drag on the tanker sector. But keep in mind, those cut levels, most of them were already initiated in June or July of 2023. So most of those cuts are simply being continued from the OPEC plus countries. And we've seen how strong the tanker rates have been throughout 2023, second strongest year in history, and that is already with those cuts. So it just goes to show how strong and how balanced the current tanker market is. Now, so that's been a bit of a headwind. Ideally, we would love, as tanker investors and folks who look at just the supply and demand of tankers, we want to see as much oil on the water as possible, and we want to see the longest routes possible. Because the way you measure shipping demand is not just total oil, right, or total consumption, it's the ton miles. How much oil is getting shipped and how far it's going. And that leads into sort of the second part of your question there, Sal, is what does record North American, specifically United States oil production mean for tankers? And that's the really bullish side of the story. That's the positive side. And that's because almost all of that oil is being exported out of the Gulf of Mexico, and a lot of it is going to Asia. And if you look at the difference in the route from the Middle East Gulf to China, India, versus US Gulf, China, Korea, Japan, India, much, much further. And it's much further if you can use the Panama Canal. If you can't use the Panama Canal, then the distances go up even further yet. So this is a very bullish thing that's happening in the tanker sector, as sort of the U.S. exports are supplanting sort of the legacy OPEC supply. I'd like to see strong supply from both sources. So that'd be my favorite. My favorite bullish case would be that OPEC reduces some of their cuts. I mean, the most bullish thing would be if OPEC goes back to they dust off their early 2020 playbook and try to start some sort of oil price war. I mean, that would be phenomenally bullish. But right now we have the headwind, which is the OPEC plus cuts, which are continuing, and we have the positive tailwind of increasing U.S. production and U.S. exports. So you've seen the rates, Sal. The rates speak for themselves. And again, 2023, second strongest year in history. And mid-sized tanker rates last week were up another 25%. So it's a very, very strong market.
Yeah, I think if you're looking at, Torm, Ardmore, Scorpio, I mean, you look at all those, what has happened here recently, you see them all kind of ticking up. I mean, that's definitely what you're seeing on those MR, LR, and when I say MR, medium range, long range, these are the mid-sized tankers that are ideally suited for carrying refined petroleum products. We're not talking about the large, ultra large containers, the very large crude carriers, or the Aframax, Suezmax vessels that tend to carry the crude petroleum. through it. Jay, we were talking about LNG and LPG. Let's talk about that sector a little bit because that's been really interesting. Obviously, one of the backdrops here that's going on is those reductions in the Panama Canal. We've seen the Panama Canal go down to about a 2/3 level of vessel passage through it. But I think the main issue has been the big lane, the Neo-Panamax lane, and the delays in getting through. And that's really been the issue. And this has caused a lot of American petroleum carriers, a lot of gas carriers, and a lot of bulk carriers coming out of the United States to sit there and say, well, I'm going to go through the Suez. Well, that all changes in a way because of what's happening. And it's caused, again, this kind of variable into the marketplace. You actually have, at this point, people bidding for spots into the Panama Canal, which normally is costing you about $300,000 to go through a Panama Canal. Now you're paying up to $3 to $4 million to get a berth through the Panama Canal because of the Panama Canal lottery. So let's talk about that LPG, LNG sector. And I know you look at not just the ships in this, but other areas in this sector.
Yeah, of course, Sal. This is interesting because normally I mentioned how the crude tankers and product tankers are different sectors and segments, but they kind of correlate. Well, normally the gas markets are at least partially correlated as well. Where one goes, they both sort of go. And this year, especially this fall and this winter, as we enter the winter of 23 into 24, the markets are going in opposite directions. The LNG market is coming off a massive boom period. After the Russian invasion of Ukraine, Europe realized they got to diversify their sources. They realized LNG is going to become critically important to the supply of that continent. And there was massive investment in new regasification and import terminals. There was massive investment into securing more LNG carriers. And so rates went very, very high over the last couple of years in LNG carriers. Now we're getting to the point where the European winter last year was way more mild than folks thought it might be. This year it hasn't shaped up to be very cold as well. Asian import growth isn't growing as fast as it has over the last few years. There's been a lot of new vessels hitting the water. The LNG rates right now, Sal, are not anything to really write home about or brag about. It's a very mediocre start to the winter in LNG rates. So let's set that aside and start looking at LPG, liquefied petroleum gas, basically propane. And let's look at what the rates there are doing. Completely opposite story. Rates are at or near all-time record highs. And the big factor for this is, first of all, the order book for LPG was much smaller than LNG. So we're not getting flooded with an endless supply of ships like we have on the other side of the market. We're also seeing demand growth, robust demand growth continue in China, continue in India. China has been opening some new plants that will convert propane into rubber and other sort of petrochemicals. And so that has driven up their demand for LPG. And finally, and really it's just the spark that kind of lit the fire here, is the disruptions around the Panama Canal. By far, the LPG ships, the VLGCs, the very large gas carriers, depend upon that Panama Canal transit to bring the cargoes from the U.S. Gulf over to China and over to India. And they are by far the segment that is being hit the hardest by this disruption. It's not a closure, but it is a significant reduction in throughput. And so the backdrop for the LPG markets is extremely strong. And if someone is listening along today or listening to a recording later, just so you can get an example of this, you can look up Dorian LPG, stock symbol LPG, and you can throw that in the chart and just see what that company has done over the last few months. And so that strength in the market is already, I think, pretty fully reflected in the stock prices. But it's really just a tale of two segments here, and they're going in different directions. The LNG outlook, the more and more I look at it, the worse and worse it looks. And the LPG outlook, every time I turn around, we're seeing more and more impressive rates and fixtures.
Sorry, trying to get that. Yeah, I think, again, that chart was just showing where LPG and LNG tankers are in the world. And you can see really, that density coming out of the United States, coming out of the Middle East, coming out of Australia, and where they're heading around right now. So I think that's a good indicator. The other element, obviously, of course, is the bulk sector. And this has been a sector that hasn't been gravely impacted at all by what's happening in the Red Sea. We're still seeing bulk carriers go, but again, we're getting the impact in the Panama Canal right now from the inability to get through there. So this has been a big issue. I would also add this is a sector that's really dependent on inland waterways. We've seen this with low water levels in the Mississippi River. We've seen it down in South America. We've seen it in Europe. And of course, what's going on in the other war that's going on in another colored sea, the Black Sea, and the ability to get bulk carriers out of there. So I thought you'd talk a little bit about that bulk sector and where we're seeing that sector moving right along.
Yeah, well, it's a good time to talk about that, Sal. And as I've mentioned in previous discussions, both on your channel and elsewhere, dry bulk is generally a play on China. There's such an overweighted impact to the dry bulk rates, depending on how much iron ore and coal and other commodities that China wants to import. But these Panama Canal disruptions are definitely positively impacting the dry bulk markets. Some of the seasonality in grain trades is also playing out. And just to differentiate a little bit here between what's going on with the Panama Canal and Suez Canal. So the Suez Canal is involuntarily reducing the amount of traffic. I mean, it is not, you can't pay more money to get more cargoes through. You can bid for a slot to get through, but it's not an open market. It's not a free system where shipping companies can just pay more money and force more ships through. That's not happening. There's a set quota that can be done per day, and it's down roughly 50% from previous levels. And that's involuntarily. You can't just pay up more money or accept more risk and shove your ship through the canal. The Suez Canal is completely opposite. It's a voluntary system where the actual canal itself is more or less working just fine. It's a matter of whether or not you want to accept that risk, the risk to your crew, the risk to your cargoes. And we talked earlier about the value of the cargoes on each ship. And by far, the dry bulk carriers have the lowest average value of cargo. And so a lot of these dry bulk carriers couldn't even really afford the canal fees to go through the Suez Canal to begin with. So I think you have your AIS chart up there in front of you, Sal. And of course, you'll see that even before the Red Sea disruptions, the dry bulk carriers heavily would go around Africa. It wasn't as common for them to go through the Suez Canal. And that's because, first of all, the value of the cargo is not very high. They can't really afford to pay the canal fees. And second of all, when you're shipping a load of coal or iron ore or bauxite, it's not super time sensitive. These things are planned months in advance. It's not the same as when you're shipping retail goods to the stores. You've got to get them on the shelves now, right? Just in time inventory and all that sort of thing. So it's a totally different type of cargo. But on the Suez Canal side, the vessels we're seeing that had previously used that route, they're still using that route. And they haven't responded as much to the safety concerns. And, I think that's morally wrong of these companies for not considering the safety of their crew and the safety of their cargoes. But the economics and the customers of these vessels drive a lot of these decisions. And it's not the same as the container ship sector, where you have these large multinational companies with billions of dollars of cargo and major forward-facing retailers and such that are involved. So I think that the liners are taking a more pragmatic and more cautious, more risk-averse approach to what's going on in the Red Sea, where the tankers are just pushing through. I think it's wrong, but they're doing that. And I think the dry bulk carriers, the majority are just doing what they've always done, which is divert, so not a lot of changes. And the minority that would already use the Suez Canal are still using it. So I think dry bulk is probably the least impacted by the Suez Canal. In fact, I don't really see any evidence that it's being impacted at all. But I do think the Panama Canal is a positive factor for dry bulk. And if you look at some of the dry bulk rates, the latest quote, now the Baltic Dry Index, they're the Baltic Exchange is the company or brokerage in Europe that sets these rates and publishes them. They're closed on holiday, Sal. So we won't be able to find out exactly what the rates are for another week. So the rates that I'm quoting now are from last Friday. So they're slightly outdated as we're talking here on Tuesday. But the Capesize rates were $30,000 a day, which is 61% higher than last year, and is one of the strongest Decembers and strongest average Decembers that we've seen in the last 10 to 15 years. One of the strongest. And so the dry bulk market is actually doing pretty decently well. And the Panama Canal is positively impacting it. But when folks start asking about, Red Sea and Suez Canal, I don't really think that's much of a story for dry bulk.
I think you're right. I have to agree with the bulk sector and the way it's running right now. And again, I was showing just the big bulkers at that time because there's a lot of bulk. The bulk is the most numerous ships out there, and so you get a sea of green on that chart if you don't clean it up a little bit. But you get an idea of where the big movement is going on right now. in that sector. Jay, we're coming into the last 20 minutes here, so I want to make sure I give enough time for you to talk a little bit about what your predictions are. Well, let me ask you something. Let's reflect for a second. We're a year since we talked last time. We've been doing pretty good at getting these in about every year. What was the thing that surprised you the most over the past year? I know there's a lot right there, but beyond the craziness that is invasions and attacks and disruptions, was there anything that really struck you over the past year that you sat there and said, "Wow, that did not see that one coming," or this had more of an effect or less of an impact than I thought it would?
Well, I think the obvious, easy answer to what I didn't have on my bingo card was the resurgence and emergence and resurgence in different waves of the Houthis in Yemen. So I think that's the obvious one. I think that surprised kind of everybody. That's more recent, but bigger picture, Sal. I think the biggest theme for us, and this was up until I would say about November, was the lackluster dry bulk season. The trade or the storyline into the end of 2022 was that when China abandoned the zero COVID policy and reopened, we would see potential economic stimulus programs, we would see recoveries in China, and we would see a huge resurgence in dry bulk demand. For the first 10-ish months of the year, we didn't see that. It was disappointing for dry bulk. So if you would have asked me 2 months ago, Jay, what's the most surprising or disappointing thing about 2023, it would have been dry bulk. It was a lot weaker than I would have thought it would have been. But the reason why I'm having all these caveats is dry bulk was really strong in November, and it was damn strong in December. And the Panama Canal has really contributed a lot to that. Some of the seasonal shifting patterns of grain trades has contributed to that. China's actually, if you look at their import levels, our macro analyst, James Catlin, studied a lot of this. Their actual import levels did go up a lot. It was just they were so much slack in the dry bulk fleet as the congestion unwound. China sort of started to absorb that slack, and it wasn't enough to move the rates. So now dry bulk is kind of like where we hoped it would be, where we expected it would be. It just took so damn long. It took 10 or 11 months to get there instead of 2 or 3. So that's one of the biggest ones, Sal, that I would say was sort of a surprise to us. And then sort of and this isn't so much macro level, this is more stock market level. But another sort of surprise or disappointment of 2023 is sort of the lackluster performance of a few product tanker stocks. And to see these stocks, a lot of them barely up year over year, even though we've had the second strongest year in history, even though a lot of these companies are heavily repurchasing stock, paying large dividends, that's a little disappointing and that's a little surprising. And I think when you start peeling back the layers and answering the why behind that, I think investors should set up super unrealistic expectations for these companies. I think a lot of folks maybe got in early and already had doubled or tripled their money. So now they waited, right, for the 1 year capital gains, and they got to their 1 year mark and they started selling their positions and locking in gains. And that's smart. Nothing wrong with doing that. So I think there's some reasonable explanations why. But from a stock market perspective, I've been really disappointed in the lackluster product tanker stocks. And that's why they remain some of my favorites today, because I think the valuations are great.
Yeah, I got to agree with you on the bulk sector, particularly. I was surprised by that myself. Kept watching that resurgence, waiting for it to happen. Like I said, November and December were great. I mean, I've got Eagle. I've been watched it the whole time, and watched a pretty lackluster year, and then all of a sudden a little bit of a resurgence there. And so it's been interesting to watch. And again, I think a lot of that has to do with downward production, maybe a move offshore, or reshoring some production back to the United States, maybe finding other sources other than China. But China's the behemoth. Again, China imports more than it exports, and we tend to forget that, especially when it comes to raw material and resources. And they're just a massive consumer of goods. And when they slow down a little bit, that has an impact across the market that you tend to see all the time. All right, well, Jay, let's talk a little bit about what you see going forward. And what James predicted. I got to go back to one thing, because you mentioned James there a minute ago. Man, what his write up just after, I think it was the December 3rd attacks, was excellent. I thought that was a really great write up. I thought he was spot on. I thought he was nailing some things that a lot of people were not looking at. And again, I'll have this up here for everybody, but this is Jay's site. This is the Value Investors Edge site. I had that link in the show notes. I'll post it again there for you to go take a look at it, and we'll let Jay talk about this in a minute. but I just wanted to have that out there for everybody. So Jay, I thought we'll talk about predictions now, maybe for a minute, get you to kind of talk about what you foresee coming forward. And again, we will hold your feet to the fire, later on and see how good you are about this. But, I think again, what we're doing here today is talking about the economic side of shipping stocks. We're not talking about pluses and minuses and what's going on around the world. So we're really kind of talking about the economics. And if people have specific questions, please post them. I'll have them up here for Jay to address at the end. So Jay, I'm going to put you on the spot here. What do you think?
Yeah, no, it's on the spot as as I'm accustomed to being. We're getting ready for 2024. So my team and I, and for those who are just joining or listen to recording later who aren't familiar with Value Investors Edge, it's a boutique research platform that focuses exclusively on maritime shipping, related energy infrastructure. We cover some offshore stuff as well. We have a team of 11, including 5 full-time analysts. So it's not just myself. I'm the founder of Value Investors Edge, but we have a head of shipping research, Clement Mullins, who probably some folks are familiar with. James Catlin is our head of macro research. We brought in a new guy, Henrik Alex. Well, not new guy, but recently added to our team, Henrik Alex, to cover offshore. So it's an extensive team. So our team right now has spent the last 2 weeks assembling our top ideas for 2024. And that list is still being curated as we speak because things have been so dynamic, Sal. So that list is actually going to be published to our members on Thursday afternoon of this week. So just 2 days from now. So it wouldn't be fair to say all those names right now or anything like that. That's wouldn't be proper. The list isn't even, the list is in pencil right now and it hasn't even been published. So I'll stay high level. I'll stay pretty high level on some of the predictions and themes I'm looking at. And then maybe I'll mention 1 or 2 stocks that I have a long position in that I've set myself up for a trade or potential investment along these themes. So one of the things I'm really looking for into 2024 is an epic continual tightening of the tanker trade. And I think a lot of folks at the end of 2022 just set these unrealistic expectations for rates of how fast it was going to develop, of how long the market or how strong the market was going to be. We had a great year, but I think people weren't happy with great. They wanted bombastic, out of this world sort of a year, and we didn't quite get that. We had a very strong year. I think 2024 is likely to be far stronger than 2023. So that's prediction, I guess, number 1. Is I don't know if it's going to be strong. 2022 was the strongest in all history. So I don't know if it's going to be stronger than 22, but I think 2024 is going to be much stronger than 23. It'll either be the second strongest or the strongest year in history for tanker stocks, or for the tanker rates. Now, of course, stocks are human nature and who knows exactly the psychology of where those will go. But I'm very, very bullish on tankers. And it's no secret. I've shared the thesis many, many times. One of the names that I've shared publicly, again, I'll stick with names that I've already shared publicly just to be fair to everybody. But one of the names I've talked about on the product tanker side is Scorpio Tankers, STNG. I have a long position in that name. And I think at this juncture, recording on 26th December 2023, I think that stock in the product tanker sector is the best position, the best valued. They have the most modern fleet. They've done massive buybacks earlier this year. And as geopolitical events started unfolding, their management team decided, hey, you know what? We're going to pay down debt all the way down to ridiculously low levels like scrap values. And that way, no matter what happens, we have optionality. They're going to hit that juncture, I believe, around April, May of next year. Might be sooner if the rates take off. And once that happens, I think we're going to see a return of massive repurchases, maybe larger dividends. So I really like Scorpio Tankers longer term under that theme, talking about 2024 being an amazing year for tankers. I have a trade right now. This isn't necessarily like a long-term investment. I don't want to get married to it. I want everyone to be clear that this is more of a trade. But I have a long position, a very long position in Nordic American Tankers, NAT. And I actually added to that position a little bit more this morning during today's pullback. And I think NAT is uniquely poised to benefit not just from the rising tanker rates, but also uniquely poised to benefit from these Suez Canal disruptions. Their entire fleet is Suez Max tankers, which are purposely designed to go through that Suez Canal. So if that Suez Canal gets disrupted any further, if the speed of average vessel transit goes down, if there's any sort of delays for like protecting convoys and things like that on the other side, on the Red Sea, that has the potential to spike Suez Max rates way up. This was not my prediction. It was an article in TradeWinds. I believe it was based on a commentary from Clarkson's, but they said Suezmax rates could potentially reach $200,000 per day. Last week, Suezmax rates went up about 12%. They were at 60,000 a day. 60,000 is an amazingly strong rate. And I don't want to predict 200,000. I think that's probably a little bit hyperbolic. I think maybe six figures, 100,000, 110,000 is probably more potentially realistic. But if that's true, if we see six-figure Suezmax and other mid-sized tanker rates, then I think NAT has enormous potential upside as a trade. I want to make that clear. It's a trade. It's shorter term. So that's theme number one, Sal. The tankers being very strong in 24. We talked about an investment idea longer term, and we talked about a trade. I don't want to just keep babbling on, Sal, so maybe we just stop with that one and see if there's any follow-ups.
Yeah, no, I think that's a really good one to look at. And again, I follow along with you, and I think that's a good one. I should also mention too that I asked Jay to come on. Jay's not sponsoring this by any way, so I just I enjoy having Jay come on. He's been a long time subscriber to the channel, supporter for the channel, but this is my opportunity to get that kind of expertise, and that's what I want this week to be. And that was the reason. There was a couple of comments that I just wanted to make sure I addressed in the notes here. So no, I think that sector is looking good. And again, I don't want you to make any predictions that you're holding for your subscribers. Obviously, I think that's something that you need to do. I think looking at some other long-term issues, you get the geopolitical. What are some things we should be looking for? That are good tells for you. Like, okay, the shipping market's about to, obviously we've got the Houthi, and that's a big one. But what's some of the things that you're looking for right now that, if this happens next, this is going to cause a change in the market one way or the other when it comes towards shipping?
Yeah, I think the two things people should be watching right now in terms of disruptions, I think number one, folks can look at, it's called the Gatun Lake. It's the lake that feeds into the Panama Canal. And so whenever the Panama Canal uses these systems of locks, right, different levels of water to transit the canal, it requires usage of this fresh water from the lake. And these lake water levels are at seasonally adjusted lows, very, very low, some of the lowest we've ever seen. And that data can be monitored for free online. You can Google it and find different graphs and charts of it. So I think that's one thing folks can monitor, because the lower that lake goes on a seasonally adjusted basis, the longer the Panama Canal is going to be disrupted. Now, if we have a massive rainstorm and such next year, as we get into next spring, summer, and we start getting different weather patterns, that could change, but that's something to watch. I think folks should pay very close attention to not the headlines necessarily, right? Like, not necessarily the letters that some of these companies are publishing to their clients to try to reassure their clients, but we should pay attention to the actual amount of container ship throughput through the Red Sea. And I mentioned sort of the letters that these companies publish to their clients, because we had a very interesting one over the weekend, right ahead of Christmas. Maersk put out a letter, and Maersk is the world's largest container ship company, or right up there with MSC. They're kind of neck and neck for the largest company. But Maersk was leading the charge to divert their vessels away from the Red Sea and talking about safety concerns. And then, very oddly, basically on Christmas Eve, they published a letter primarily to their customers, sort of reassuring their customers and saying, well, we feel better now that the U.S. protection group is there. We're going to send some of our ships back. But they're talking about a handful of ships. And this is a company that operates hundreds of ships. So I think the second thing I would watch now is the actual throughput of vessels. I know you're doing a great job doing that, Sal. So subscribe to Sal's channel, and he'll keep you updated, and follow the right folks on Twitter. Those are the two things I sort of watch and sort in terms of disruption. Now, geopolitically, Sal, I don't want to get too far out of my lane and into predictions there. I've seen some crazy stuff on Twitter, Sal. Twitter, X, oh, yeah. I should say X. I mean, I've seen some nonsense out there, like people saying the Persian Gulf's going to be closed and the Houthis are going to beat the U.S. Navy. I've seen some insane stuff on Twitter, and I don't want to get too far out of my lane on that stuff.
Well, you hit a couple of things, Jay, right there. So number one, I am such a massive loser that I have on my phone an app that gives me the Gatun Lake water levels. I actually have that like my weather is like I have an option on my weather for Panama, what's going on in Panama, so that I can watch it, because this is what I look at all the time. I think the Maersk thing you said is a really interesting one. I had a conversation with somebody this morning about this, and I think Maersk is really interesting because you're right. They led the charge. They went away, and now they're coming back. But if you look at what they're doing, it's like 10 ships coming out of Europe coming through the Suez heading southbound, and like 2 or 3 heading to the Suez. And to me, that's repositioning. They're repositioning containers. They want to sweep up empty containers out of Europe, get them over to Asia so they can stuff them again and send them to ships largely going on the diversion route. Because again, one of the things that's going on right now, as of January 1st, they reset the long-term rates for ocean carriers between Europe and Asia. And so if they can keep the diversion going, that allows them to get better rates. And these are the type of things that I know Jay and I look at all the time when it comes to shipping, because container liners will work long-term rates, whereas the tanker market, LNG, LPG, is more spot. I mean, it's more lifts and what's available at the time. So it's a different market. And a lot of people who will invest in shipping don't understand the nuances of that. In some ways, that shipping, container shipping is very much like the airline schedule. It's all said. It's cut and paste. This ship's leaving on this day at that time, whereas tankers are going to where the money is, and they're always kind of flipping around that way. So, all right, well, we're coming up in the last 5 minutes, Jay. So I want to give you an opportunity to wrap up in case I didn't cover anything for you. I want to make sure you have an opportunity to hit on any topic that I did not get a chance to do. And I'm going to take one last look through the comments here and see if there's any good questions for you.
Yeah, well, I'm sure there's lots of great questions. Every time we do one of these, or there's a chance for live questions, I always see some great stuff. So I'm happy to extend a few minutes to answer some questions if there are some. I think the other sort of interesting theme and dynamic into 2024 is going to be the volatility. I think we're going to see extreme volatility in container ship freight costs. Now, I'm not necessarily making a strong bullish nor bearish prediction, but I am making a prediction on volatility. I think we're going to see rates skyrocket up and down throughout the first few months of 24. And I think we'll see stocks like Zim just continue to be for traders. We're talking about short interest at record highs. We're talking about freight rates being volatile in both directions. We're talking about a global sort of narrative around the container freight and around what Maersk is doing and what these other container ship companies are doing. So I think that excitement and that volatility is going to be here with us. Now I have a small, long trading position in Zim, both in common stock and also in some January options, getting a little spicy there. And so I'm going to have fun trading that one. We'll see how it turns out. But I think Zim's going to be exciting, Sal. And I think fundamentally speaking, I think tankers are really the place to be. And interestingly enough, Sal, a lot of the tanker stocks, 1 or 2 of them responded, but a lot of the tanker stocks are barely up or flat month over month, despite everything that's happening. And that is absolutely crazy to me. I am extremely bullish on tankers and might be just as bullish as I've been over the last couple of years on tankers.
Yeah, could you, we had a question about a little bit more about LPG tankers or LPG market, if you don't mind.
Yeah, no, of course. And it's a good question. And imagining you've already kind of seen what we've recorded and we've done live here. There's not a lot more to add in terms of the broad fundamental story. This is a strong market. We have strong demand growth in India and China. We have strong export growth of the United States. There's a solid arbitrage between the lower cost U.S. exports, the higher cost LPG imports in Asia and India. So that's a strong market. And then you add on to that the order book has been sort of pushed out and delayed a little bit. So there wasn't as much supply as folks, including myself, had expected. And then finally, you sprinkle in the Panama Canal disruptions. And so I think that's really the story in a nutshell of what's going on there. Now, I must, to be transparent and disclose things, I currently have a small, it's via some puts, but I have a small short position actually in Dorian LPG, the stock symbol LPG. I think the stock is, I think it's a great company. I love the management. I like the fundamental story. I think the stock's gotten a little bit overheated. I wouldn't BS anyone or nothing like that. I want to be clear about my positioning. So I am not a fan of those stocks. I see absolutely no reason why I would ever invest in an LPG stock when I could invest in a tanker stock. I just don't. And I'm just being transparent and clear about that. But the fundamental story is solid.
Yeah, and I think, when you look at LPG, LNG tankers too, in terms of even construction, if you start building them today, a tanker is going to come out quicker than LPG, LNG. There's very few. It's Korea and China that's building them right now. There's a long lead time. It's getting longer to build ships. It's more expensive to build ship. The ship costs are going up. One of the things we've seen since 2009 is consolidation in the shipyards. We're down about 40% of where we were back then. The cost is going up. The time to build is going up, even in places like China, Korea, and Japan. So, even when you start looking at those long-term replacements, everyone was thinking when the gas got cut off from Europe from Russia, that was going to cause a lot of issues. And what we saw was a pretty benign winter last year. And so we saw some crazy LNG rates there for a while, $100,000 a day. It was insane. And then what we saw was 30 LNG tankers sitting off Europe waiting to offload because there wasn't the shoreside facility. And it wasn't so much the storage facilities, it was the processing to go from liquefied natural gas to natural gas. But now Europe has fixed that a lot. We're seeing a lot more of those stations being built so that they can do that. So I think you got to be a little careful in that sector. The other question I saw was this one. I thought it was a really interesting one: how to handle the case when a peace deal in Ukraine happens and the tankers suddenly crash. I don't want to talk about the crash as much, but I think being aware of when the geopolitical changes is important. It's really important to be watching what happens, and I don't think you're going to see a crash per se, because I think one of the things that you've talked about extensively is how that tanker market doesn't have a lot of play in it to begin with. So that even if you invest, I think what you would probably, and again, you could disagree with me if honest, and please let me know what you think. I think all of a sudden you start seeing those old tankers go, and then the market becomes even more dicey going forward. I don't know what you think on that one.
No, I'm glad the question was asked. And it's a good question. I certainly don't mean anything against the question, but I'm so glad it was asked, because I think it is just totally emblematic of this absolutely false, in my opinion, bogus narrative out there. And keep in mind, I just finished my dissertation on this very topic of tanker market disruption and rerouting of cargoes. And so by my best estimate, and there's other folks who've done independent analysis as well, we have stuff from Clarkson's and Lloyd's List and other sources, the amount of rerouting and ton mile impact caused by the sanctions was around 6%. So it's about a 6% net change overall at this point. Now the first couple months, there's all sorts of crazy stuff happening. Europeans were panicking for distillates. There's a lot of front running of sanctions. That's all settled and that's all happened. That's all done. So the current impact from sanctions is roughly about 6% to ton miles. But look how many vessels are over 20 years old that have absolutely no place in a legitimate commercial trading fleet. Look how many people are turning 15 plus, and they're going to be impacted by EEXI, CII, the European trading regimes. And these are ships that right now have no part in any of those regimes because of their status in the dark fleet. And I think if you look at the amount of ships that are in the dark fleet, the amount of ships that have no place in a valid commercial trading fleet, it's much, much higher than 5 to 6%. And so if there's peace, I think we have to be careful when we're talking about trades and investments and what we're wishing for and hoping for and all that stuff. I hope there is a reasonable conclusion to this crisis in Ukraine. And I don't even see that as being a valid. I mean, when I look at the trade-off between the sanctions and the dark fleet and the amount of ships, I don't want to go out of my way and say that would necessarily be super bullish, right, on shipping. But I think most likely it's a wash. And I think if you give it 6 or 7 or 8 months for the ships to start to re-enter broad global trade, then I think it's probably net bullish if that happened. And this is all predicated on this fact that suddenly not only is there going to be peace in Ukraine tomorrow, which we should all hope for, but not only that, but then all of a sudden the entire European plus US regime is going to just give up sanctions tomorrow. And the fact that sanctions are going to be completely dropped if Russia doesn't relinquish any territory or doesn't pull back and give concessions and reparations to Ukraine and pay for the massive damage that's been done there. Again, I try to stay in my lane, but I think it's predicated on a lot of assumptions. But I'm glad the question was asked, because I get that question almost every day. And I've probably gotten that question 20 or 30 times in the last couple of months. And it's sort of this notion that, first of all, there's a ceasefire right around the corner. Second of all, sanctions are going to just drop. And third of all, I think it's sort of a misunderstanding of the balance of the dark trade and the dark fleet and the age of those ships.
Yeah, I also think too it goes to demonstrate how volatile shipping has become. I think the norm. Again, I got Bruce Jones on Thursday, who wrote To Rule the Waves, and he talks about how superpowers use the world's oceans. And I think we are seeing, number one, shipping companies playing a much more important role in driving not just economic factors, but political and military factors. You saw, like you said, it was Maersk that all of a sudden pulled out, and the other shipping lines followed it. It was the same way with Maersk pulling out of Russia when Russia invaded Ukraine. And I think as we get into a much more volatile global situation, then the market will also be volatile in some cases. And we see what happens with the Houthi, who, like you said, nobody had Houthi on their bingo card for 2023 that they would interdict 15% of the world trade, or at least affect 15% of the world trade. And again, this is a non-state actor hurling missiles, and really they haven't hit that many ships, and yet all of a sudden it's created this massive disruption. And so I think that's the big volatile thing going on. Jay, I'm going to bring up your site one more time and let you have your kind of closing here. I appreciate you coming on. It's been an hour. I don't want to keep your time because I know you're working on a different shift than me. So for Jay, this is the middle of the night. So we're going to try to get Jay off here in a second. I want to appreciate you coming on. And again, I want to invite everybody to go check out Jay's site. I have I've had the link here in the show notes for you. I'll have it posted with the video here, so you can go to it afterwards, check it out. So if you're checking this video out later on, you're not watching it live, you'll be able to see it and link right over to it. Jay, any last closing before we sign off for this year and look forward to hopefully a better 2024? But I've been saying this since 2020 and it hasn't seemed to be getting better yet.
Well, I mean, Sal, if you would have asked me one of my top predictions a year ago, we are long only models on Value Investor's Edge, which are just stocks, not options, nothing crazy, literally just an average of stocks that we pick. They went up 55% in 2022, Sal. And if you would have asked me at the end of last year, what is one of my surefire predictions for 2023, I would have said, we're going to do less than that. I mean, I would just be thrilled. I would be blown away if we did even 30% in 2023. And as of this morning, the long only model portfolios were at 57% in 2023. So I can just, hope that, as we enter 2024 for half as good of performance next year. But seriously, for folks who are interested in what we do, we are a boutique research platform funded by investors, by the family offices and hedge funds that work with us and pay for our research. We have yearly plans and monthly plans available. And, if folks don't like our research, they don't sign up for it. They don't pay for it. So we have to deliver the results. We have to be ahead of the curve. We have to be ahead of these things. I'm not always right. I make mistakes all the time. But in shipping and in these sorts of markets, if you're right 50, 60% of the time, there can be some enormous returns. And Sal, it's always great talking with you. It's always great chopping it up. And I look forward to continuing this dialogue and back and forth into 2024. And if tankers don't do well in 2024, Sal, I expect you and everybody else that's listening today and listening to the recording, hold my feet to the fire, drag me around and say how wrong I was. I've been wrong before, but I am very bullish tankers. And I want to make that very clear.
Hey, and I will have the link in the show notes here for the past talks I've had with Jay. You can go ahead and take a look at where we've been in the past talking about it. Jay, it's been great to have you on. I enjoy every time we get a chance to have a conversation. I am jealous about the Harvard plaque in the background with the flag, being a doctor from Harvard and everything. But my doctor is from Alabama, so we may be national champions here in a week or two. So I know you were cheering on Air Force the other day.
Hey, what an end of the season. We can't compete with Alabama though, so I'll give you that.
It will be the end. If Alabama wins, that'll be the end all to drive everyone's head to explode when it comes to the National Football Championship. Jay, I want to thank you again. Just for everybody who's watching, Thursday at noon Eastern time, we're going to have Bruce Jones on to talk about the geopolitics side. To rule the waves, and then on Friday, hang on tight. John Conrad's coming on. I don't know where we're going with that, but we're going to be talking about news for the end of the year and recapping everything. So, Jay, I appreciate it again. It was great talking to you, and look forward to talking to you throughout the year.
See you, Sal. Bye.